Welcome to the future of development finance, financing the COVID-19 recovery and beyond. I'm Catherine Cheney, a senior reporter at Devex, and I'm looking forward to conversations that will not just highlight, but hopefully actually inspire the innovative financing tools and partnerships that will be critical to achieve the Sustainable Development Goals. This time last year, Devex hosted the first edition of this event in London, and as you all know, a lot has changed since then, to say the least. The COVID-19 pandemic that has us gathering virtually today brings more urgency than ever to this topic. So before we dive into the agenda, let's watch a quick video on the importance of not just conversation, but actually action on this topic of innovative finance.
I think that this pandemic has clearly demonstrated how fragile we are. That to overcome these fragilities, we need to unite in solidarity.
The response in financial and fiscal terms so far is inadequate. We are not only witnessing the inability of many poorer economies to really be able to cope both with the health crisis, but also with the economic and social fallout. We are seeing a mounting debt problem, and we are heading towards a moment where this could become contagious.
There has to be a whole different way of doing this. Can we use our pension funds better? Can we use local and domestic resource mobilization better? How can we ensure that we can crowd in the private sector into resolving this current crisis, but also crowd them into seeing how we build forward?
Now more than ever, we need the private sector to step up and partner with governments and nonprofits and society to help address these SDGs at a critical time. We would like other financial institutions to try coming up with some of the best innovative models to achieve real impact. We need this for society, and consumers are demanding this.
We can do better than build back the pre-pandemic world. We can build forward to a world that is more resilient, sustainable, and inclusive.
And now just a few additional notes from me before I introduce my colleague Adva Saldinger to kick off our first session. We encourage you to share takeaways from this conversation on social media. Our Twitter handle is Devex, so please tag us there. And hashtags for this event are hashtag Devex event and hashtag future of dev finance. So please submit your questions as well using the Q&A box. We'd love to make this as useful and interactive for you as possible, so keep those questions coming. I also want to note that there will be live interpretation in Spanish. You might have seen those directions at the beginning of this session. So if you're joining via a desktop, just click interpretation at the bottom of the screen and select your preferred language. If you're joining via mobile, click more at the bottom of the screen, choose interpretation, and select your preferred language. Finally, this event is hosted in partnership with Microsoft, IDB Invest, and FinDev Canada. So I wanted to thank our partners for helping make this event possible. With that, I'd love to introduce my colleague, Adva Saldinger, senior reporter and associate editor at Devex, who will be leading our opening plenary. Adva?
Thanks so much, Catherine. It's definitely an exciting day, and this event does look different than last year, not only in terms of where we all are, but in terms of what development finance looks like and what has more emphasis this year compared to previous years. To kick us off today, I'm really excited to welcome Amit Bouri, who is the CEO of the Global Impact Investing Network. Amit and I have had the opportunity to speak regularly over the years, and so it's a real pleasure to have you with us today, Amit.
Well, it's such a pleasure to be here. Thank you for having me.
And I wanted to start by talking to you a little bit about what you've seen as sort of the impacts of COVID-19 on impact investing, particularly as it comes to development finance and directing impact investing to low-income countries. I know we talked about this a little bit earlier this year, but I think we've even seen changes in the last, 4 or 5 months.
Yeah, it's such an important topic, and obviously one that we're keeping on top of at the GIIN. One of the things that we've seen is that there is a great need and a recognition of the need for more impact investment capital to drive the response and recovery from the COVID crisis. When it comes to emerging markets, though, we've seen both a great interest amongst investors in deploying more capital to those markets, but also some challenges. Some of those challenges are very operational. How do we conduct due diligence? How do we source deals? How do we move things through a pipeline in an environment where we are so constrained? Many impact investors who are active in emerging markets have focused their early energy on shoring up the companies already in their portfolio, providing them with more capital and more technical assistance. But I think in this next phase, there'll be a lot more kind of exploration of how do we source new opportunities and help build businesses that investors didn't have relationships with before.
As you're talking about the demand we've seen, I think we've seen it beyond what you might define as impact investing. We've also seen a growth in sort of the ESG and sustainability space and some bold commitments by financial institutions. You had the UBS announcement that sort of, for their wealth clients, the default was going to be sustainability investing. And I'm curious what you think that means for impact investing. How do we start to ensure that some of those metrics and benchmarks are in place so that capital is, making a difference and doesn't just get a certain label? And then, how does that translate to development finance? Is there a role that development finance institutions can play to sort of try to get some of, this growing interest of capital to play in this space?
Those are all big topics, so I'll take a crack at them. I think, first of all, our focus at the GIIN is on driving scale with integrity. How do we move more capital at scale, but also make sure the integrity of impact is front and center for that capital? So these issues are very top of mind for us. I think that we are seeing a broader recognition among mainstream investors that if we are to achieve the Sustainable Development Goals, if we were to actually have a world that is truly just, sustainable, and inclusive, we have to invest differently. So we think the inbound interest for many large financial institutions from around the world is a very positive thing, with one big caveat, and that is, of course, that money is actually flowing to things that do genuinely have a positive impact. We're in a moment where there's declining trust in institutions. People are not just going to trust promises or platitudes, but they want to see real results. Results at the community level, results at the national level, and of course at the global level. And that's where that other topic you brought up, the need for rigorous impact measurement and management, is so important. We've been supporting the IRIS Plus system since it was launched. It includes over 11,000 users around the world, and we're seeing a strong uptake from mainstream institutions. So it's not just the remit of the development finance world or philanthropy, but actually mainstream investors are seeking that rigor for how they measure and manage their impact. To the last part of your question, development finance institutions play a critical role. They have a wealth of experience, track record, relationships, and as we see more investors interested in having a positive impact, DFIs have to play the role of helping to push the development impact agenda and help to draw in more mainstream capital. You heard from the video the need to crowd in private capital, and that is so critical at this time because people will want to follow those who are already experienced and deep in these markets.
I guess my question to follow up on that is, what do DFIs need to be doing differently then? Because some of the space DFIs might have been playing in the past, maybe private capital will be willing to sort of come into more of those spaces. So how do DFIs need to be reimagining what they need to be doing in this context?
I think it's an important moment for DFIs to continue to push their own evolution and leadership in these dynamic markets. DFIs played a role of going where markets didn't go before, both in terms of geography, of course, but also in terms of development impact, pushing beyond what the private sector would do if left to its own devices. As we see an uptick in investors who are interested in sustainability and impact investing and even impact thinking, that means that the role of DFIs needs to push out further on the frontier. How do they support the business models that aren't yet attractive to mainstream investors focused on impact investing? How do they help those investors go into opportunities that they wouldn't go into before? And also, how do they make sure that there's a great rigor around impact performance, not just impact intention? That will be absolutely critical for the DFI's role and their leadership in this next phase as we emerge from the COVID crisis with an eye towards the decade of action for the Sustainable Development Goals.
Yeah, and I know you guys have been doing a lot of thinking about sort of this measurement and impact management piece, and really looking at, how can you create better alignment, which I think will be relevant across the spectrum from all sorts of investors. I know you recently released a couple of reports looking at how to create better alignment in agriculture and financial services. And so I'm curious, how can investors be more aligned? What are you seeing as you're doing some of this research about what needs to happen in terms of creating this better comparability, so that not only is there this confidence in impact, but that we can actually compare across different funds, investors, et cetera, to have a more realistic picture of what they mean and are more comparing apples to apples?
It's so critical that we actually understand the impact that we're having, both to inform our strategies and drive a race to the top of how we can drive stronger impact performance. We've been thrilled to work with the DFI community, in particular the IFC and the European DFI Association, EDFI, to help harmonize metrics around impact measurement. And we've built that around the IRIS Plus system. Once people are speaking the same language, using the same metrics as they're contained in IRIS Plus, that sets the stage for what I think is really exciting, which is analysis of actual performance. The reports you mentioned that we released last week are focused on impact performance. We worked with a dozen investors who were using commonly defined metrics for impact measurement. And they shared their data with us so we can develop an actual methodology for how we compare impact performance. Not just between businesses and between portfolios, but also in terms of the context of the issues that investors are trying to address. So those reports in particular looked at financial inclusion and agriculture, two huge areas for development finance and very critical to the emergence from this COVID crisis. But that methodology can be applied across the board. And my hope is that as we develop more benchmarking and comparability of impact performance, that will lead to greater impact intelligence. We'll start to understand what actually drives better impact that will allow the entire market to foster collective learning and raise the bar on what impact investing and development finance can accomplish.
Great. Well, Amit, thank you so much for your time today. And I know this is quick, but really great to have you participate and have your voice, and always appreciate your insights.
Well, thank you so much for having me, and I'm really excited for the agenda you've lined up. So I'm looking forward to a very productive day.
Great. Thanks, Amit.
Thank you.
And we're now going to move to our first panel. And I'm really excited about this group that we're bringing together. One of the things that has really emerged over the last year is that COVID-19 has thrust certain financing needs into the forefront that maybe weren't as top of mind last year. And I think chief among those is the issue of debt and the need for debt relief, as we've seen sort of mounting debts in the wake of this crisis, and an increasing number of countries struggling to finance their response as they try to continue to make debt payments. We've seen a number of efforts from the IMF, from the G20, et cetera. And so in this conversation, we're going to talk about debt. We're going to talk about efforts to boost government spending. We're going to hear about Angola's experience. And we're also going to talk about what this moment has meant for entrepreneurs and for private companies. And so it's my pleasure now to introduce you to our panel. We have Ceyla Pazarbasioglu, who's the Director of Strategy, Policy, and Review with the International Monetary Fund. We have Tokunboh Ishmael, the co-founder and managing director of Alitheia Capital. And we have Aia-Eza de Silva, who's the Secretary of State for Budget and Public Investment of the Republic of Angola. So thank you so much for joining us. Really excited to have this rock star panel of women to help kick off our day. And the opening question I wanted to pose for all of you is really, you each sit in sort of a unique position. And so I'm curious, as you look at the COVID response to date, what do you think has been one of the things that has worked particularly well, and where are some of the efforts falling short? And Aia-Eza, maybe we'll start with you.
Well, good afternoon, everyone. Well, for us this afternoon, I know that for some of you, it's good morning. When you ask what has been going particularly well, you are talking about the as a whole, or to talk to us from our own experience?
Yes, absolutely. So from your experience in Angola, I'm curious, I mean, one of the things that has been interesting is that you have managed to negotiate some debt relief with creditors, and including with China. And so I'm curious, sort of from your perspective, what has that experience been like? Where have the challenges been in getting that done?
Yeah, well, thank you for asking then. We have been some things going very well for us, actually. As you guys know, we are under a program with the IMF. We just had our third revision approved, and that was very, very helpful for us. Because one of the main factors they were debating with us was our debt sustainability levels. So we had it approved. It means that our debts is still sustainable, and that was a relief. However, as you mentioned, countries like ours are just drowning in debt, and we have this huge service to perform, and the revenues are really falling short. We have a dependency on a main commodity for our budget revenue, and these commodity prices have been falling since this started, and it has come to the historically low prices. Today, the market is performing more or less, but still we have been under a huge financial pressure in order to keep ourselves performing reasonably well. So having that approved by the IMF was actually very important to us. We also have this ongoing talking with China, which is our main international creditor, and it also has been going fairly well regarding the circumstances we are trying to negotiate it. It's not easy for us. It's not easy for them as a creditor. So we have still ongoing calls going on. We also have the DSSI initiative for the G20, and also very well managed and followed by the IMF, which has been, and I have to congratulate Ceyla as the only representative of the institution here, because they have been very keen and doing all on their power to put the countries together and make them really correspond more and more to that initiative. So we cannot say that everything is a failure, right? However, we have to say we are not very rich countries. We do not have these great packages of helping coming to us. We are in a situation where we have still to pay the debt that we owe, and this is something that is very important to do. So it's not something that it's, and we have the shortness of revenues. So it's not something that it's very easy to manage. What have we been done? We have been cutting expenditure. We have been delaying contracts, we have suspended contracts, we have been making sure that we have our finances on track, and also putting together a lot of reforms in terms of better controlling the expenditure and making sure that each penny is spent, it's well spent and efficiently spent. So this is what we have been doing. I heard your conversation on the opening remarks, and I was actually very pleased to hear that people in the private sector, people in the private finance are also moving very closely with this issue, because all the help is welcome.
Great. Thank you so much. Ceyla, I want to go to you now. And you obviously have a broad view of what's going on. And we talked a little bit, we just heard from Aya about the specific situation in Angola and the ongoing challenges despite some of the relief through the debt service suspension initiative of the G20, et cetera. And I think the question for you that I have is, we're entering in this next month, we're expecting a special meeting and a meeting of the G20 to really look at a framework for broader debt restructuring. I think what is clear is that, a delay of debt payments will not be sufficient for a lot of countries. So tell us about where we stand. What do you think those framework discussions will look like? What does a good debt, restructuring framework look like as we move forward?
Thank you, Adva, and it's a privilege to be with this great panel. Big reformers, Angola, we heard about just now, and also to Devex. So I just want to step back for a minute. If you look at what has been the response to this crisis, you saw about $12 trillion in support to firms and households, major central banks coming in with interest rate cuts and other measures amounting to $7.5 trillion. And I'm mentioning this because it's very different than the global financial crisis in 2008. We had this unprecedented shock and unprecedented response, but it's very uneven. So advanced economies are doing whatever it takes. They have injected something like 20% of GDP. But then when you look at emerging markets and low-income countries, they're doing whatever they can. And with support from us and others, it's 6% of GDP for emerging markets, 2% of GDP for low-income countries. So the response has been very uneven, and that really requires everyone to support this, because otherwise we're going to have a lost decade in many countries, and that's just not fair, nor does it make economic sense. Private sector has responded as well. We have seen emerging markets issue like $124 billion between January and June, so they were able to issue. But again, it's not for all. In sub-Saharan Africa, no one has issued any debt. So I'm putting this in perspective because the situation is dire. It's very uncertain, as we keep saying. At the fund, we have provided financing to 81 countries, $31 billion in emerging financing to 76 countries in a very agile and quick way to support countries so that they can make these important health and other payments. In terms of the common framework, why is that important? Because you don't want countries to delay necessary expenditures for growth going forward, because debt sustainability requires growth as well. So how do we make sure the debt suspension initiative was good? It allowed countries to defer payments. It allowed them space to make these important health and economic expenditures at a time when revenues are falling, as was just mentioned. And the common framework goes beyond that. It brings all creditors together, all official creditors, whether they're Paris Club or non-Paris Club, together to agree on the parameters for any reprofiling or restructuring of debt. And that's very important because in the DSSI, we kept saying, everyone talking about bringing in the private sector, comparable treatment, but that hasn't materialized. There are many reasons for that. We can go into that if needed. But the point is the common framework, which is in principle agreed and should be hopefully endorsed by in November, is to bring all official creditors together to agree on the terms so that the private sector also participates and we have comparable treatment.
Thanks. Tokunboh, I want to turn to you. Can you sort of share with us, what are you seeing in terms of the companies you're investing in terms of your ability to raise capital? Have you seen things change at all over the course of this crisis? And what do you need? What do the businesses you're investing in need at this point? You're muted, Tokunboh.
Sorry, thank you. So as Alitheia Capital, for us, it was quite interesting because we raised a fund just before the pandemic and we brought on some new investors just as the lockdowns were happening. So we were in a good place. And we were also glad and fortunate to see that the strategy that we have, where we're looking at investing in companies that are providing access to essential services, health being a key one, education being key, energy being key, all three sectors that were very key for households, especially in Nigeria and South Africa during this lockdown period. So for us, it was confirmation, not that we needed it, but again, for the naysayers, it was confirmation of the need for our kinds of strategy of investing for more than just financial returns. So what that meant was that obviously the kind of companies that we're looking at suddenly were put into play in terms of needing to be at the forefront of responding to COVID. So of course, healthcare, I don't need to say much about that. And having the financing to be able to provide the PPE that was then distributed into the markets was very key for some of our our pipeline companies. For some of our portfolio companies, though, they had to pivot because suddenly their business models, especially where there was a huge physical aspect to their business models, were under threat. So even if you're an essential service, if the people can't get to you, then that's an issue. So the good thing as well, though, is that because we focus on how we can leverage tech to make essential services accessible and affordable, it meant that a good part of our pipeline and our portfolio were able to weather the storm. Some of the interesting aspects for us were those that had to pivot because their model was suddenly put at play because of the lockdown. And we saw examples of that both with some logistics companies that we invested in that moved from passenger transportation to goods transportation as e-commerce took off. Digital loans, we saw actually an increase in the disbursement of those loans because they don't need the infrastructure, but the people were able to gain access to money and therefore have money put into their electronic wallets. So, and then also even for one of our companies where they did have both the digital aspect, but also a physical aspect, the physical aspect, which is an agent network, was in the communities, right where people were. And so they were able to step up as an essential service and provide cash where needed because they were cheek by jowl in those communities. So for us, what we've seen is that, first of all, what it revealed is the huge gap in investment that has not gone into essential services, and the secretary was talking about how money is going to countries. But the question is, how accountable is that money and those investments? And what we see is that by being able to be intentional about the kind of impact that we want to have with money, we can raise the accountability on how money is deployed.
Great. And so I will come back to you, Aia-Eza, and sort of with that question, you talked about one of the things that you're doing in this period is looking at reforms and looking how to improve spending. And so I want to push you on that a little bit. What are some of those things that you've done? How are you ensuring greater accountability? I imagine this likely will be a part of some of the debt discussions going forward to ensure that, you know, any sort of debt restructuring or repayments comes along with reforms. And so I'm curious from, you know, to hear a little bit more about those reforms, and then also to hear about, you know, you said you were cutting funding, and I'm curious where you're cutting that funding. And I think one of the trends we've seen is that sometimes funding to services like education and health are being cut, which can be especially difficult at this time. So those are the two questions. Hopefully I can get sort of short responses to each from you about what those reforms you're doing look like, and what that new accountability system will be, and then where some of those funding cuts are coming.
Well, let me just assure you that all the cuts we have been done, we have very closely do fall very short from cutting from education and health. We actually have increased this spending on the last 3 or 4 years as never before. We are doing a lot of investment, especially in the health sector. So the cutting has not go for the social sector, as we call them. And the reason, as you mentioned, we face challenges on these sectors every day. And if we did have more money, we would put more money there. So we cannot afford to not spend on those sectors. But we have been cutting on other equally and strategically important sectors like infrastructure, roads, railroads, and so on. And those are equally important for the development processes. But if we do not have how to pay, we cannot just afford to keep on doing things
have
that
to make difficult choices. And so on the reforms that you're making, what sort of accountability reforms are you making at this point, and how much of that is sort of required through some of the debt discussions that you're having?
Yeah, so as you mentioned, also we and someone on the Q&A also have mentioned, we Angolans are not really. For many years, we were known for having these huge and very corrupt government. And as you know, today we have been doing a lot in terms of trying to make sure that we fight this very, very pandemic situation that we have faced for many years. And as you understand, it's not something very easy to do because it's something that is in here. So we have to make sure that things are done, but we still have to keep on working on other issues. But if you go to our program, and the IMF has it published, we have a sort of named most of the initiatives that have been going on. In terms of public finance, I can mention to you 2 or 3. We have put together a system where, and the Tokunboh also addressed a little bit on that, where we can actually make sure that all the projects have been on a proper, I don't know how to put it in English, but you have to bid for being able to conquer and to win the project that the public sector is developing. We also put together a system where we can do it iteratively, so people that are very far away can also be able to to participate and not just being allocated to 2 or 3 main players that always play and always win all the contracts. We also have made sure that we put together, and because we did that, for example, in the health sector, we have been having projects that in the past would be having a price that is like 3 or 4 times greater than it is today. So prices are really coming down. We are also making sure that a lot is done in terms of the prices that are being played in the public sector. So if projects are just usually priced, they are just not implemented. They have to go for a second evaluation before we are able to go forward with them. But again, you are in a hurry, right? And we have other people to talk. But if you go to our program, I have other documents I could show, but if you go to our program, because it's published and the IMF has it on its website, you can see the many initiatives we already had and that we are also developing with them in terms of transparency, in terms of making sure that fiscal accounts are more organized and better published.
Great. Ceyla, I want to come back to you. We've talked a lot about debt, but one of the things I wanted to talk to you about is, the other sort of role the IMF is playing is to try to free up some additional liquidity. And one of the ways that the IMF could do that is through SDRs, and which are special drawing rights. And I think that one of the things we've seen in the G20 negotiations is that there's a real holdup right now in terms of a new issuance. But there's also lots of talk about how could you get some of the world's wealthier countries to donate unused SDRs from the last issuance. So tell me a little bit about what is sort of holding back the SDR discussion today. I understand the US government has made some objections in these discussions, and where do we stand in terms of creating vehicles for using those unused SDRs to provide additional liquidity and capital to countries that need it?
Yeah. So of course the priority for us is to make the most vulnerable members can manage the crisis and strengthen their recovery. And we have been fast, agile, and pragmatic to be able to help countries, and really concentrated on measures that can be put in place quickly and are most likely to be successful, such as improving our existing instruments and expanding our toolkit. Since March, we provided financing, as I said before, to 81 countries, of which 48 are low-income countries, amounting to over $100 billion. So our lending commitment now is over 280 billion, with additional room for member countries to tap into the IMF's $1 trillion lending capacity through programs. So we have the firepower, if you like, to support member countries, especially those that are most vulnerable. We provided debt relief, which is now extended under the Catastrophic Containment and Relief Trust, which helps the poorest and the most vulnerable members, about 28 of them, with a total debt relief for the first, this has been about $500 million. Now, in terms of the general allocation of SDRs, we have many countries that have expressed interest in them, but the support for a new allocation falls short of the 85% voting majority that we need. So we have been focusing pragmatically how to better use existing SDRs. Several countries have already been providing loan resources for the Poverty Reduction and Growth Trust, the PRGT. By using their SDR holdings since the start of the crisis, we raised $21 billion in new PRGT loan resources, and about 2/3 has come from existing use of SDRs. Just to also put it in perspective, a general SDR allocation, say $500 billion, low-income countries, because of the quota, could receive about equivalent of 3.3% of it. So in line with the quotas, that's about 16.5 billion. So we really, so it's pragmatic to focus on what we have, use what we have, which is really, we are able to support countries. And I want to add one thing quickly, Adva, because this was a great point that was brought up by both panelists, which is the need for accountability and transparency, both debt transparency and investment transparency. This is so critical. And supporting these measures with capacity development, public sector, private sector, procurement reforms, as was mentioned, is really transformational. So I cannot agree more that this is top priority for us. Transparency, debt transparency, and we have many countries that are reforming and they want to reform. So I really appreciate that this point was made.
Right. Tokunboh, I want to come back to you, and you talked about how so many of the companies you're investing in are sort of based in a digital infrastructure, and we've gotten a couple questions come in about sort of digitization and both what governments can do to create an enabling environment for some of that digital infrastructure, and how it's changing and services are being designed. And so wanted to throw those questions to you before we wrap up here.
Easy answer on what governments can do: infrastructure, power infrastructure. If you look at the ease of doing business, getting electricity to do business is a big issue. And especially if we're talking about digitization, you need power. So power reforms, I can't speak enough about that, and the ease of getting connected to the grid or even to an off-grid solution is something that needs to be looked at. Really, I don't think there's any business that's waking up each day nowadays, especially post-COVID, that's not thinking, how can I reduce the physicality of my business, or how can I bring in digitization to improve the physicality of my business? And so we're seeing that, whereas maybe a year, 18 months ago, the amount of the use of funding that was going towards digital or tech infrastructure was maybe even 10% of what we're seeing today now, where when people are raising funding, they're definitely already thinking, and it's part of the heart of what core of what they're thinking they want to use their funds towards, is how can I make my business more ubiquitous? How can I bulletproof it against these kind of physical issues? We're seeing more of that. So it goes without saying, digitization is upending that whole narrative.
I wanted to ask one more question to you, Tokunboh, and one of the challenges, especially sort of early in this crisis, that I was hearing a lot about from DFIs is sort of some of the challenges of doing due diligence. And I wonder, as an organization and country, who's on the continent of Africa, what you've seen in terms of the demands on your time, in terms of activating your networks, in terms of doing some of this, and what you think, is there an opportunity there for local fund managers that's growing in the wake of this crisis?
No, absolutely. Local fund managers are key. I mean, DFIs and foreign fund managers are seeing that you need presence on the ground, you need proximity to understand the problems, and you need proximity to be able to proffer the solutions. DD, a lot of us have tried to do that online, but there's only so much that you can do online. You still need to have the ability to go in to kick the tires. So to the extent that people can't fly into the continent, the local fund managers have a place. But what I would say is that we also need more domestic capital to encourage the growth of that local fund management market, so that the domestic capital, the domestic limited partners can partner with the development finance that's coming into the country. But all in all, whether it's foreign direct investment, development finance, or whether it's local LPs, at the end of the day, accountability. How is the money being spent? How is it having an impact? COVID has shown us that we can't just spend the money or deploy the money. We need to make sure that there's impact in these essential sectors of the economy. Otherwise, we're all toast.
So we've got about 1 minute left, and Ceyla, I want to come to you. We had a question come in asking if there is a general allocation of $500 billion in SDRs. Are there existing IMF mechanisms for shareholders that don't need them to transfer their holdings to low-income countries and lower middle-income countries? And what would it take for that to happen? And like I said, we've got 1 minute left, so.
Yeah, I mentioned already, so yes, we have been doing this allocation of SDRs for the PRGT countries, 21 billion already. So yes.
That mechanism could also be used if there's a new allocation.
Of course, yeah.
Great. Well, I wanted to thank all of you so much for being part of this panel. It's been great to hear all of your perspectives. So thank you so much for your time today.
Thank you.
Thank you for having me.
And next, I want to introduce our next panelist, and really excited to move into this fireside chat with Rémi Rieu, who is the CEO of Agence Française de Développement, AFD, and he also chairs the International Development Finance Club. Rémi, welcome. Thank you so much for joining us. I know you have a very busy schedule and there's a lot going on, so I appreciate your time today. The first question I wanted to ask you was really sort of to push you a bit, and that's that, in response to past crises, DFIs and MDBs have often been criticized for sort of not investing countercyclically, not investing enough. And so I'm curious how you would rate the COVID response so far, and what more sort of needs to be done that maybe hasn't been done yet.
Yes, good morning, everybody, and thanks for the invitation. Yes, hard times, preparing lockdown here in Paris again. And so, yes, that's a very, very serious question you're raising, meaning what is the capacity of public development banks as public financial institutions with the governments, with all public actors to play fully their counter-cyclical role in such a crisis. And you remember that PDBs are experiencing a renaissance during each world crisis. It was already the case in 2007 and 8. And so we are somehow living it again. If I may, for your audience, please clarify what PDBs means for me. I mean, this is an encompassing concept that gathers 450 institutions. So it's broader than maybe what you talk about when you talk about development finance. And it's important to change the perspective, because then you can really measure the counter-cyclical capacity of this group, which amounts to $2.3 trillion a year. I would say a normal year. We will produce a database, so that's 2018. And probably we will discover that we are way above this mark in 2020. You know, MDBs are playing fully their part, expanding in a crisis, somehow doubling in poor countries right now. And MDBs are only 150 billion. The rest, all the national development banks, you see 1/4 of the stimulus plan in France goes through Caisse des Dépôts. KfW has been nicknamed the bazooka of Germany by Mr. Scholz. BNDES in Brazil represents 10% of the recovery plan.
So I guess my question, as we look at this bigger group of PDBs, of private development banks, and that is obviously sort of a bigger view, though some of them do spend sort of domestically in their own countries rather than in low income or lower middle income countries. What do you see as sort of the greatest challenges facing that group today? How do you think they can better cooperate? What will it take to do that? Because I think one of the challenges is a lack of coordination? How do you ensure, and whether that's on metrics, whether that's on individual projects? And so that's where, where do you think you can have better cooperation? What are some of the challenges in getting there?
First, I would say there's an issue of somehow a bias, or maybe a stigma that is still attached to public development banks that we have to remove. And at the Finance in Common Summit, 9th and 10th of November, there will be a high-level research conference. Joe Stiglitz, Nick Stern, Mariana Mazzucato, Masoud Ahmed, Carmen Reinhardt, the IMF will produce a paper, about 20 new research papers to clearly identify what we are talking about. Then you're right, we certainly need to form and further structure the community itself. And this is also what the Finance in Common Summit means, inviting these hundreds of institutions and see how we could build a coalition, an architecture with MDBs, of course, at the top of the pyramid, but with embarking all the others to have a stronger say. And not for ourselves, I would say to finance in common, meaning to interact more broadly, more effectively, more ambitiously with the governments, with private sector, with civil society, with local authorities, with foundation, all of them invited at the summit. That's
and so beyond. Yeah, no, I was just going to say beyond the summit. What if we're looking beyond the summit? Do we need a new institution that's sort of going to help coordinate all of this? What does that architecture that you mentioned look like?
We urgently need international cooperation, and we need not a new institution, but we need to open the relationships and invent this reconciliation, I would say, between quantity, we talked about it, and quality. Because you have the counter-cyclical challenge, but you also have the structural challenge, that of climate and inequalities. And PDBs are incredible sensors of how could we reconcile these various dimensions. And of course, at the time, it has to be conceptualized. It had to be set in a global framework on what sustainable finance really means. And we are not there yet to know that. There are 185 initiatives on what ESG, green finance, well, Devex know that better than anybody. At the time, it needs to be streamlined, it needs to be clarified, and there's a lot that PDBs together can share on this.
I guess my question is on that streamlining, on sort of, creating definitions that can be agreed upon. Over the years, that's happened within the financial sector, right? There have been agreement about how you define a specific type of bond instrument or other, financial mechanisms. And I'm curious what you think it will take to get there. Obviously, both development finance institutions, MDBs, the broader group of PDBs have been working on some of these things, and we've seen some things translate. We've seen, green bonds take off. But as we're looking to solve some of the perhaps harder to quantify social challenges, how do you sort of, get there?
I'm optimistic. The mandate, the signal was sent only 5 years ago, in 2015. And what I'm really, from the friendship within the group of PDBs, I really believe me, we have a deep consensus. We know what we have to do. Now the question, and you're right, it's question of action. It's a question of acting at scale. It's a question of having the right tools to mobilize the private sector and go maybe beyond and have the right methodologies for that beyond the group of PDBs itself. So what we're able to do historically, and certainly we have to do more, and that will be discussed at the Finance in Common Summit.
And so do you think that we'll actually see, mainstream capital markets shift substantially to this way, take on some of the work that's been done among PDBs as they're looking at sustainable financing? Because I think that there is a concern now that as sustainable financing grows, that it sort of becomes a label without bite behind it, without the actual metrics or measurement to ensure that it's achieving some impact.
Remember, the green bond markets was mostly, not exclusively, but structured by EIB, by the World Bank, by PDBs. And now, maybe you've noticed, AFD, we are the first French issuer of a sustainable bond, relying on a very precise, I think, credible methodology. So we are also the place, we have the business model to experience and to develop these new tools beyond our lending or investment capacity. So we are more and more into guarantees. You know that. Jutta Urpilainen will be at the summit to explain what the European Union with EFSD Plus is doing on guarantees. And so I think all donors should pay a closer attention to what PDBs can do, provide them more concessional resources. This is what EU, but also the Green Climate Fund is doing more and more, you know that. And then maybe an area that has not been explored for now is the connection between the central banks. Now, you know, providing liquidities in the system, and the PDBs maybe organized as well as a system, and see if all these liquidities at the time could lend into concrete projects, into the economy, and mobilize the private sector. And for that, you're right, PDBs probably have to go more upstream in the value chains. They have to generate way more bankable projects. This is our intention, but for that we need to have a sound business model. We need to pay the salary.
I guess to just push you on that, I feel like for years people have been talking about the need for more bankable projects, right? This isn't a new conversation, and yet, you know, especially and obviously our focus is on, you know, low income, lower middle income countries where financing is particularly difficult to get, where, you know, in some cases there just really aren't that many bankable projects right now, even if, you know, the group of development finance institutions wanted to invest in them. So, you know, and I know, you know, like the IFC is looking to move in this direction in some ways, has talked about doing that, but really what, you know, tangible, actionable steps can these development finance institutions, can these public development banks take to actually move into that space, rather than just talking about the lack of projects and the need to do this? I think we've been having that conversation, but it hasn't so much translated into action.
Well, we are disbursing $2.3 trillion a year. So I just want to start by saying it means a lot of projects finance, and of course a lot of these projects are co-financed with the commercial banks and the private sector. So we're not starting from nothing, from a blank sheet. Then when I say we should allocate concessional resources for project preparation, for capacity building, for in a more in an optimum way, I would say, this is to have, especially national development banks, originating quality projects way more than what they are doing right now. And the other dimension is we have to go from financing to enabling, meaning that these projects should not stay on our balance sheet for decades. Probably we could find a pricing, we could find a good business model that help us pass these brownfield projects to the private sector at an earlier stage than what we are doing today. And this is, of course, important. You've understood that I'm talking way beyond the North-South divide. I'm talking about SDGs in each and every country. But of course, this is Devex, so there's a very important dimension of the issue about solidarity, about leaving no one behind. about making a very specific effort in direction of developing countries to avoid the decoupling risk we are facing. This tale of two cities, Kristalina Georgieva stressed during the IMF and World Bank meetings.
Great. Well, we have about 1 minute left, but we did have a question come in that we'll see if you can try to answer in 1 minute, which is, what do you see as some of the chief constraints that development finance institutions face as they're trying to carry out their mandates? And I think this obviously, varies depending on how they're structured, but from where you sit, and you obviously have a position where you're hearing from a lot of DFIs.
Maybe let me plea to conclude for Africa. We have 95 colleagues, public development banks in Africa, so it's exactly the same number as in Europe. They are fantastic. I don't know if you know Serge Kwe at BOAD, if you know Admasou Tadesse at TDB, if you know...
Admasou will be with us later today.
Excellent. Benedict Orama, Patrick Dlamini, Abdelatif Zarnoun, they are really fantastic. They are providing already $35 billion to finance African economies each year. They could do way more if we reinforce this institution financially, if we strengthen their capacities. European practitioner networks will work on that, and multilateral development banks, AFD, KfW, JICA, all those that are committed to international action and to the development of Africa should do more for this region.
Great. Remy, thank you so much for your time today. It's always a pleasure to speak with you.
Thanks a lot. Thanks, everybody.
So we've talked a little bit about impact measurement, but this next panel is really going to dive further into that. And so for this next discussion, I'm going to turn things back over to my colleague, Catherine. Catherine?
Thanks, Adva. Thanks for a great discussion. So earlier we heard about the need for rigor around impact performance and not just impact intention. And that's one of the issues I hope we'll get into in this session as we ask what's next for impact management. We'll kick things off with a video from IDB Invest, which is the private sector arm of the Inter-American Development Bank Group. We're going to learn a little bit more about its impact management framework as one example of what impact management looks like. Now it's my pleasure to go ahead and welcome our panelists. Alessandro Maffioli is the Chief of Development Effectiveness Division at IDB Invest. Faheen Aliboy is Managing Director of the JP Morgan Development Finance Institution, which was announced in January 2020. Andrew Herskowitz is the Chief Development Officer of the U.S. International Development Finance Corporation, which my colleague Adva has reported on extensively in recent months if you want to learn more about their development strategy released earlier this month. So I want to begin with a question for all of you, which really narrows in on these structures you've set up, what problems they aim to solve. So IDB Invest has been implementing its integrated impact management approach for over a decade. We just got a little preview of that. JP Morgan and the DFC have just recently built these impact management and metric systems. So again, take us back to what was the biggest problem you were trying to solve that wasn't working in your previous system? And we'll start with Alessandro.
Yes. Well, good morning, everybody. Thank you very much, Catherine, for inviting me to this panel and for this question, which is a very interesting one. as you mentioned, we have been in this for quite a time. We started having our own impact score in 2008 and manage our portfolio looking at both impact and financial contribution since then. Then over time, we have been improving this system. But I have to say in 2016, where we had the merge out, so the reorganization of all the private sector activities of IDB Group and the consolidation IDB Invest, that was really the opportunity to look at this again and see what we could improve. So I would highlight two challenges and two key efforts we made. One was we look at our impact rating system, and we wanted to make it a little bit more rigorous and more grounded into the idea of the estimation of a social economic rate of return. So what is the return for the society of this investment? Something that is similar to a financial return, but the return for the economy, for the society. And of course, accompany this with a stakeholder analysis, not only what is the return, but for whom, who is really benefiting from this investment, a sustainability part, and what the additionality part. So what is our role in making all this happen? So that was the idea we had, and we had the mandate to make this operational. So that is a big challenge. How you build something that is rigorous, embedded in something that is clear how it works, but still remain operational. And operational for us means that it's predictable. So our investment officer understand how we measure things and what we are looking for in the transaction. Though it's always an expert that then give the final score. Is flexible, so it has to be something modular, can be applied different kind of transaction, and in the end is also cost effective. There's an element that I'm an economist as a background. You give me infinite data, infinite time, I will produce the best possible estimate of the impact. But that is something that doesn't go with being operational in financing projects. So that was the challenge, and so the result was the Delta, the Development Effectiveness Learning Tracking Assessment tool, and which we believe that really summarize well this characteristic, rigorous and operational. The second challenge we had was to strengthen our ability to go end to end. So the cycle of investing for impact start from the origination process. What kind of deal you look for? So what are the priorities? What are the development challenges we want to address? What are the deepest problems we want to tackle? Then the structure and origination, the supervision, because once it dispersed, then when really the development story starts. So we disperse our resources to a client and then makes the investment here where development happened. So we wanted to strengthen our ability to monitor results during the execution of this investment, so we can manage it with our client. We want to partner with our client during the investment. And then the final part, which is evaluation, which doesn't simply fulfill an accountability purpose, which is very important, and for us as NDB is super important, but mainly and also a learning purpose. How do we learn from what we do? How we are a learning organization that can learn from what works, what doesn't work, and we feedback in the way we select and structure projects. Those were the two biggest challenges. And if you want to see the results of this, in addition to the short video, we just issue a publication that explains our system and is available on our website in case you want to go deeper into that.
Thanks, Alessandro. Fahim, I want to turn it over to you. And part of why I'm so grateful to have your perspective on this panel is you come from the world of development finance. You previously worked with the International Finance Corporation and are now working within JP Morgan. So you were brought in to solve a problem. Can you outline what that problem was that your system is set up to solve?
Absolutely. So thank you so much for having me today. It's a pleasure. So the JP Morgan Development Finance Institution was set up earlier this year to really try and bring development finance to the capital markets. As emerging markets become more sophisticated, as they move towards capital markets to raise money, be it debt, equity, or different types of other financings, we felt that there was a need to try and bring that development framework to those transactions where commercial and investment banks like JP Morgan operated. As you know, the DFIs work really as buy-side investors, right? Giving money directly to their clients, whereas a commercial and investment bank is a sell-side operator. They're raising money for their clients by bringing in institutional money from institutional investors. And we thought we had a very interesting role to play there to make sure that those deals done in emerging markets with a development angle could have that proper framework. So you're absolutely correct. I do come from the world of DFI, but unbeknownst to me, even before I joined, JP Morgan already had a working group in place with the IFC and also took in an input from many of the other DFIs to say, how do we bring in best practice impact methodologies to and adapt it to our business model? So we looked at AIM, we looked at many others and tried to then have a methodology that we could bring to our clients and our types of transactions, which, as I said, happen on the capital markets. But then we have developed something that is very similar to what AIM does, which is looking at the development gap of that transaction. It's a use of proceeds transaction, use of proceeds analysis. It looks at the development gap and then it looks at the investment contribution. What we've also done is try to look at how these transactions contribute to the SDGs. We're seeing stronger investor demand for projects that have a link to the SDGs, and we wanted to help make that a little bit more clear. And this is really now, this impact methodology, which we put on our website the day we launched, is something that is fundamental to what we do. So when we go to a client transaction, we now have a framework that is credible, that's been shown to the DFIs, but also to the broader public. And we can evaluate transactions against this methodology. And, I wouldn't get into all of the details, but it has a lot of the elements that have been mentioned by the earlier panelist as well. We are very cognizant of the fact that this is a work in process. And ever since launching, I have a team with a director of development impact. So we've given this a lot of, resource, have been speaking with the likes of IDB Invest. They've been a great partner with DEG, with FMO, and then more industry level players such as GIIN, right? That also has impact methodology, HIPSO, which is the alignment of different DFIs, and the joint impact model to say, how can we better it? And as we do transactions, we will improve. We attempt to improve our methodology and make it more adaptable to the capital markets.
And Fahim, we had some questions coming in for those who are less familiar, to just clarify some of the acronyms. So I'm familiar with some of these institutions you mentioned, but can you just break down again, who are some of the institutions you're in touch with? And if you could just spell out who these entities are, like the GIIN, who we heard from earlier.
Absolutely. So these are, I have to think about who all the acronyms are, but the GIIN is essentially a coalition of people looking at impact investing. And they've really been an early leader in this and have coalesced a lot of impact investors to see if we can find standards and to standardize the way impact investors look at impact, and in our case, development impact. HIPSO is a group of development finance institutions that want to kind of align our methodologies because there's so many different methodologies out there. And the joint impact model is a coalition of both development finance institution and some private money to do the same.
Thanks so much for that. I want to hand it over to Andy. So Andy, I think many people in our audience might be working through the nitty-gritty of this within development finance institutions. So can you just talk us through again the problem that your system is set up to solve and how you designed the system to address that problem?
Sure. DFC, the U.S. International Development Finance Corporation, was, first of all, we were excited to be launched in January of this year. And then a few months later, we launched our impact quotient tool, the IQ tool, which measures impact in a way that we hadn't done before with our predecessor agencies, OPIC, and also USAID's Development Credit Authority. One of the issues that we had previously is we weren't really looking at country context. We also weren't weighing impact. I mean, we were looking at impacts, but everything was being weighed the same way. We weren't taking deductions for adverse impacts either. So we really, we looked at those issues and we came up with a new system, which is really meant to be a living tool. And we're doing things like we're actually assigning values, looking at the degree of the particular type of impact. There are three basic categories that we look at. We look at inclusion, we look at economic growth, we look at inclusion, we look at economic growth, and why am I drawing a blank on the third one? Oh, on innovation, of course. So innovation as well. And so each of those things get weighed. And when you look at inclusion, inclusion might be something like jobs. It's a big difference between whether a project is going to be adding 10 jobs or is going to be adding 1,000 jobs. Previously, you would have gotten the same credit for something like that. So we have algorithms that we've developed, which aren't perfect, but that do make adjustments. And then if there are social or environmental issues, we make certain deductions as well. And then we also use the IQ tool, not just as a way to measure impact, but it's a way to incentivize and create impact. So we would sit down with a client and say, have you considered implementing these policies that might provide greater social benefits to your employees? And if they do that, they may give them additional bonus points as well. So we're using this as a way of, because every client ultimately wants to have their project classified as being highly developmental. So we're using this way as almost a carrot to try to encourage clients to have greater impact than they otherwise would have had.
Thank you. Now, when you set up these systems, a big part of the process is really changing incentives, which is hard within an institution, right? With long time systems and traditions. I want to talk about incentives, and I know we've spent some time kind of digging into your models. Let's go a little more rapid fire here. When it comes to setting up these new models, how do you change incentives, for example, by embedding impact into how people are evaluated on their performance? So I'll start with Andy, if that's all right. How does this?
So it's tough. So this is tough. This is one that we're getting ready, trying to tackle right now. I've been having conversations about this because we're a government institution, and you're dealing with government employees whose salaries are fairly set, and the bonus is, we're not private sector. You don't have these massive bonuses for having certain incentives. But I always reassure myself that the people who work at DFC are doing it because they care about development. So even when we just launched our brand new development strategy called Roadmap for Impact, which has baked into it specific metrics, specific outcomes that are tied to people, such as getting people access to potable water, getting people access to electricity or the internet. The question came up, well, can we put this in people's performance metrics? The truth is that being heavy-handed like that doesn't really work. At least in government, it doesn't, because everybody has a new idea and everybody has a new metric. And next thing you know, the people are all trying to meet all these different metrics and they're constantly shifting. So we're counting on the fact that people are bought into what we're trying to do. I compare it to the 2X initiative, which DFC has, which works on women's economic empowerment. People are excited at screening and credit and investment committee meetings when they talk about how the project is advancing the 2X initiative and creating jobs for women, or that the company has a lot of women on the board. It doesn't require a lot more than that. So I'm hoping that people will be equally excited about these other things.
Thanks, Andy. And we'll hear a bit more about the 2X initiative later today. So I appreciate you teeing that up. Alessandro, can you jump in on this question? What does this look like in terms of incentives and measuring performance, as well as managing portfolios?
Sure. Thank you. No, and so building on what Andy was saying, we did introduce some incentives that of course, we don't have a level of bonus or merit pay as private sector, but we do have something. So we did introduce as a metric for our investment officer also a reference to the delta score of the transaction at entry and during execution. So that is something we did do, and there is something that, of course, there are various metrics included there, and we think that it is powerful, especially because I think our people are very embedded in the mission they have, and it's good to in a way reward this effort. Though in a portfolio approach, you have to be careful, because of course there are other metrics we are looking at, also how we contribute to our financial sustainability and many other factors we are looking at. So it's one of the things we look at, and within this health in terms of creating the right incentive. In terms of portfolio, I think in addition to the micro incentive at the level of the person, is important also that you create incentive at the level of the organization. So having targets in terms of, we have targets set in terms of how we meet our top priority, gender lending, lending to small and more vulnerable country, lending to MSMEs, and so on and so forth. Those are things that help to guide how you build a portfolio, in addition to have a delta median score as a target. Also consider the delta score, we have a minimum threshold. No transaction can be approved for us if it doesn't meet a minimum threshold, which increase as when the financial contribution to the transaction diminishes. So we have hard threshold there. We have a median score that we need to meet as an organization, and we have incentive at the individual level, try to push the organization. And the point of Andy is absolutely true. In the end, we are invested with this mission, but it's a way also to check ourselves and to create reward for good work done in these areas.
Thank you. And as we're running short on time, and I do want to make sure to bring it to this moment in COVID-19 and what these structures look like in this moment. So Fahim, feel free to jump in briefly on that question around incentives and measuring performance. But I did have a question come in from the audience that I want to direct at you as well. Someone from the audience asks, would you withdraw from an investment which develops to have a very high financial rate of return, but a very low return on social and environmental metrics? I think that might be a question around where does an investment like that fit within JP Morgan, or if an investment doesn't pan out the way you might have expected. So feel free to jump in quickly on that previous question, but then would love to hear your thoughts on the question from the audience. And you're on mute.
I think that first question is very important because it's been very interesting to see how incentives work in a private sector environment. And it shows a little bit of a difference in probably what the two other speakers mentioned. The incentive in a commercial and investment bank is getting deals done. So what I have found really impressive is that when we have come in and partnered with our product teams and gone and spoken with clients, and clients bite at wanting to have this development impact analysis done and to show it to investors, teams latch on immediately, because if their clients like it, they want to do it. Everyone is incentivized to kind of move in that direction. So I think that's been super interesting. And the second part is the demand from institutional investors. It is clear that the large institutional investors that invest in emerging markets want to do more in impact, in climate, in SDG alignment, in fact. And so when clients see that the institutional money coming towards them are coming from folks that care about this, again, the incentives are aligned. So for me, I've just seen kind of the pieces of a puzzle kind of coming together, and incentives being aligned around those who see value around development impact. And what I would like very much is, we've seen what's happened in the green bond market, right? At some point, it became patently clear that this is what investors were demanding. So more and more clients and issuers move their offering towards that space. With respect to the audience question on financial return, we are very clear in our methodology that no transaction that we, the DFI at JP Morgan, would look at would not pass all of the typical filters of JP Morgan. So that includes JP Morgan's exclusion criteria, and there's some, already baked in there. Credit criteria, know your client, and reputation. So all of those things are the first filter, and one of those is credit. So the credit process is robust, independent, and will happen regardless of the development wrap that we bring to the transactions. So we don't see any kind of trade-off in that respect. We just hope that sometimes by bringing additional DFI money into a transaction, we may help with credit enhancement or risk mitigation, but there should be no trade-off with any of the basic parameters that JP Morgan looks at.
Thank you. Now, this may be our final question, so I would ask speakers to be kind of rapid fire in your responses here. But as I mentioned, I want to bring it to this moment. So each of you have developed your separate systems. We've learned about those systems. But one of the things mentioned earlier in our event today was the importance of speaking the same language and using the same metrics when it comes to impact management. Now we have this global pandemic disrupting a lot of the investments you're making and probably a lot of the systems you've set up. So can you just quickly touch on how do your systems work together when it comes to measuring impact, particularly as COVID-19 complicates the picture and raises the stakes? Anyone who wants to jump in first on that, and briefly. Go ahead, Alessandro.
Well, I can say something briefly. I think that in the end, the point is measuring what we measure in the same way. All these systems boils down to certain indicators we're tracking and we want to measure, and then it's as plugged into certain algorithm that we use to produce an impact score or development gap and a quotient. So I think that the most important work, Fahim already mentioned, this working group on harmonization of indicators. So make sure that when we say we're going to focus on job creation, we measured it in the same way. Everybody's asking the same question, the same data, and we process then if the processing of this lead to our own algorithm that is, I don't think is though there is a work on that too, convergence in terms of standards. We have the operating principle for impact management that are setting standards for how this system they should look like. There are certain models emerging who's looking at more monetization like us, more gaps and as ever. But I think that, so there is a harmonization in the models, but the most important thing, measure what we measure in the same way. And of course, the SDGs help also in terms of speaking the same language as the private sector. There's another big thing for us to translate everything then into SDG contributions that we can work with co-investors. That's it.
Thank you, Alessandro. Measure what we measure in the same way. Are we making progress? Fahim, go ahead.
Yeah, no, I think I would agree with Alessandro. We are not changing the way we would evaluate a transaction because of COVID. I just think that COVID has given us an incredible opportunity because the demand for putting money towards social health and sanitation, many other things is just growing. The demand is growing, and the level of disclosure that people are doing. So people are raising COVID bonds and social bonds, and people realize that their citizens and their shareholders and stakeholders are asking to say, what exactly are you doing in this pandemic to help make sure that we tackle the economic and health impacts today, and also prepare ourselves for the future. So I think it's really put a spotlight on development impact, both in emerging markets as well as developed markets that were not prepared. And I think that but the methodologies shouldn't change, and we should have similar indicators to which we can report to.
And Andy, we'll close with you, how these systems can work together.
Look, so DFC's, let me make sure. Okay, DFC's approach is always to be as collaborative as possible. We all are participating in the Global Impact Investing Network, and we're working with HIPSO as well. So, and then we also have this DFI network, the DFI Alliance that we created in response to COVID as well. The holy grail is we can talk about collaboration all we want, but people have to actually operationalize that. We have to share deal flow. We have to make sure that we're not viewing one another as competitors. We are, in the end, at least for the DFIs, we are public institutions. We are multilateral banks. We have to treat ourselves that way and not emphasize our own bottom line over the public good. And so we have to share information. We have to think about whether collaborating is going to benefit people as much as possible. Something we have to always remind ourselves.
Well, thank you so much to our panelists, and this sets us up nicely for our next conversation, where we will be continuing on this topic of COVID-19 and what it means in this space. So Adva, I'll hand it over to you.
Thanks so much, Catherine. So next we're going to talk about blended finance, and blended finance over the last few years has been sort of a topic du jour in the development broader development finance discussion. And I wrote a piece earlier this year really looking at how, despite a lot of excitement around blended finance, it hasn't necessarily taken off. It hasn't scaled to the degree that folks think it could, folks think it should, to sort of enable it to reach its potential. And so we have a great panel today to talk about what's being done, some of the challenges, how we might address them. And before we kick off, one of the challenges in this space is really that there isn't a single definition on blended finance that everyone agrees to. The Organization for Economic Cooperation and Development, the OECD, has a definition, which is that blended finance is the strategic use of development finance for the mobilization of additional finance towards sustainable development. Whereas the IFC, and we'll hear from the IFC on this panel, defines it as the use of relatively small amounts of concessional donor funds to mitigate specific investment risks and help sort of balance risk-reward profiles of investments. And so, this issue of whether blended finance requires concessionality or not creates some challenges in how we measure and discuss it. So we'll be sure to try to specify as we discuss today in this conversation. And so it's my pleasure to introduce our panelists now. We have Martin Spicer, who's the Director of Blended Finance at the International Finance Corporation. We have Nadia Nikolova, who is the Lead Portfolio Manager for Allianz Development Finance Strategy. We have Laura Sennett, a policy specialist at the UN Capital Development Fund, who focuses on blended finance issues. And hopefully Admasu Tadessa, the CEO of the Eastern and Southern Africa Trade and Development Bank, will be joining us, but I think he's got a few technical issues that we're trying to work out. So we'll kick off the conversation and bring him in when he's able to join. So, you know, Martin, maybe I'll start with you, because I know you've spent a lot of time thinking about some of these blended finance definitions and have worked with a set of DFIs at IFC to create a set of blended finance principles, which have been out there now to try to create sort of more understanding and a sort of more framework around what blended finance is. And so I wanted to ask you what progress has really been made since those principles were agreed to, and you know, what insights you might be able to share with us from the upcoming Blended Finance Compendium IFC is going to release on how to overcome some of the barriers that we're seeing today and accelerate blended finance.
So thanks a lot, Adva, and thanks for inviting me and ISC to be part of this session. Over 20 different DFIs have signed up to use these, they're called DFI blended finance principles, to filter projects and decide whether or not a project needs the support of the concessional funds. And these DFIs and ourselves define blended finance as the combining of concessional funds into a project with commercial funds, whether those be from a DFI who operates on commercial principles or true private sector investors. And many times these concessional funds are structured in a way to either reduce the cost of funding to allow a project to go forward because of the buying power of a consumer. Maybe it's a power project that needs to obtain a certain end tariff for users for affordability issues. Or blended finance is structured to de-risk and help improve the risk profile for an IFC or for an alliance to come in, so that it meets that particular commercial investor's risk reward profile. And this is what one of the principles, which is minimizing concessionality, is trying to find what is that level of concessionality or subsidy that is the minimal amount in the structuring of an investment to de-risk or rebalance risk return. And just if we look at IFC's investments over the last 10 years, we've used about $1.6 billion of concessional funds to support IFC. And this has helped IFC invest over $6 billion of its own account and crowded in over $7 billion from others. And just last year, we committed 500 million of that 1.6 billion. So the ramp up, at least from our perspective and what we're seeing from other DFIs, is there's an increasing use of these concessional funds to support our own activities. And the challenge is continually justifying the economic rationale too, is we're trying to help create markets and not distort. And so besides the structuring element, having an economic rationale, a market failure that needs to be corrected, and that's related to both the impact that the project could have, as well as the additionality that a DFI brings that provides financing at longer term than might be otherwise available in a less developed country. Thanks.
Yeah. And Laura, I wanted to turn to you. One concern that's often been raised is that as we look at blended finance deals and we look at when concessional capital is put into play, we're still not seeing as much of that in least developed countries. If you look across portfolios, the research that's been done has shown that most of it, in fact, is going to higher income countries. And so I know this is something that you work on a lot at UNCDF. I know there's an upcoming report with OECD coming out, but what do you think is needed to ensure, and as DFIs are doing this sort of accounting of when and how should we use our limited concessional capital, what can be done to ensure that it's going to least developed countries, low income countries?
Great, thanks Adva. Thanks for having me and UNCDF here today. Yes, indeed, at UNCDF, we focus on the world's least developed countries, or LDCs. And so we are looking at this very closely. As you mentioned, we have an upcoming report with the OECD. It's our third report on the topic of blended finance in the world's least developed countries. And the data shows, again, that only 6% of private sector finance mobilized is going to the world's least developed countries. So it's a very small percentage of that finance going to where it is potentially needed most. Some of the issues, of course, are the risks that Martin's already mentioning about that need to mitigate some of the risks. And there's a long list of risks that in the LDC, some of these markets are just not ready for certain issues, such as sponsor capacity, the size of the deals, the development of the private sector market in that country, the high cost of capital in these markets. The list goes on, and we can, of course, talk more about that. But the question then becomes, what can we do to mitigate some of these risks to make sure that we can get some of this finance to the world's LDCs? There are a number of different ideas out there that are being sort of talked about right now. At UNCDF, we take really an investment continuum approach. So some of our work is actually in grants and technical assistance and capacity building in order to get projects ready for finance. And we're able to then take them from that stage to then give them concessional loans and guarantees on our own balance sheet as well. And then after that, we've set up 2 different third-party managed funds that can provide even larger ticket size, semi-commercial loans and some potential equity as well. And so by preparing those projects and creating a pipeline, we find that we're able to really catalyze additional finance into these projects. There are other suggestions made by Convergence Finance, which is very big in the blended finance field, that they really advocate for a portfolio approach. That one of the issues in LDCs is that the ticket size is too small and the projects are just so small that the cost of doing these projects is so high, it's not worth it, given the risk and the potential return. So by taking a portfolio approach, aggregating a number of projects or syndicating a number of them, that you can somehow raise this and that it makes it more interesting for investors. And another thing that Rémi mentioned from the Agence Française de Développement is the role of the national development banks in these countries. They have a really unique position in that they know the context of their countries really well. They're able to lend in local currency, which is really important for, which is another risk, sort of the currency exchange risk in LDCs. But as Rémi mentioned, these institutions need to have a really strong governance structure and need to be properly financed and able to play a larger role in this space.
Oops, I was muted. Nadia, thank you, Laura. Nadia, I want to turn to you next. I think one of the things that's often talked about in the development community is the challenge of getting institutional investors to participate in development finance. And so, Allianz is an institutional investor. You invest in this space. So tell us a little bit about how you've been able to do so, how those efforts can be scaled, and what you see as the role of international financial institutions and development finance institutions in enabling institutional investors to come in.
And thank you for having me here. I'll actually continue on the thoughts that Lara was going. We very much lay with a convergence of this world where we think portfolios are the ways to go about it. We manage more than 1.8 billion of blended finance commitments out of Allianz, and the way we've managed to scale to that number is really where we've been looking to blend at a portfolio level rather than individual project. I think a lot of the work has gone on individual projects where a lot more blending is required to get investors comfortable with all the risks that Lara went into detail with. Which means that 1, we require a lot more capital. 2, individual investors don't necessarily have the resources to analyze individual projects in specific countries. So I think there are basically 3 reasons why we don't see blended finance having kicked off tremendously. 1 is lack of track record. Most of us talk about perceived risk being higher than actual risk. Unfortunately, the GEMS database, which I think is one of the biggest impact achievements if it ever happens, if it were to be published, has not been published. So institutional investors are told, yes, emerging markets are not that risky. But
tell us what the GEMS database is, just in case people don't know what it is.
The GEMS database is basically most of the development banks' historic track record, their losses, their experiences in general, whether that's from a profit perspective or an actual net loss perspective. And in every new asset class, if you're trying to crowd in institutional capital, you need to be able to quantify the risks in order to know how to price that risk. And so long as that database is not out there, it will be very challenging to crowd in institutional capital. A lot more blending would be required in order to mitigate the risk that we actually are not able to quantify. The second issue that I see in these markets is one of incentives, and Catherine talked about it in the previous session. I think my favorite thing in the world is a capital starved development bank, and I keep on saying that IFC was the most innovative of its states I found at the times before the last capital injection. That's when we did the MCPP program. That's when they started issuing large-scale green bonds. It gives different types of incentive in order to crowd in capital. And the third one is education. And we touched upon this earlier again. It is communicating in the same language, understanding who can contribute what in the system. And I think we haven't managed that quite well yet, but we are making very, very good progress. The mere fact that you have public and private people on this panel in itself is something that wouldn't have had a few years ago.
Great, thanks, Nadia. And we'll probably come back to some of these issues in a little bit more detail. One question I did have for all of you is, you know, we're in this moment where COVID has sort of upended a lot of what we're doing in this world. And so I'm curious how you've seen COVID impact blended finance efforts. We're certainly seeing pressure on development and aid budgets and on that concessional capital. And so I think folks will naturally have questions about whether that should, be given as direct grants, whether it should be used to crowd in private sector. And so I'm curious what you've seen as the impacts so far in terms of COVID-19, whether there's an opportunity, what some of the potential challenges are today. And Martin, maybe we'll go to you first, and hopefully we can sort of go rapid fire to each of you to get your thoughts.
So thanks, Adva. Yeah, soon after March, IFC pivoted to address the COVID crisis among our clients and set up about $8 billion of facilities to do that. About $4 billion have now been committed. And what we did with blended finance is help support the effort to continue investing by IFC in IDA and fragile, like low income and fragile countries. And so that's how we've used blended finances to keep IFC's mainstream focus on the less developed countries, because without the de-risking, IFC by its nature and trying to ensure continued financial stability would have stayed with middle income, less risky investments. And so of that 500 million I mentioned earlier that we committed last year, about 250 was actually devoted to these portfolio type of facilities that Nadia mentioned for working capital and for trade finance as a way to quickly deploy and in a sort of emergency situation, IFC's funds supported by the blended finance. Thanks.
Laura, you want to jump in?
Sure. Yeah, that's definitely what we've seen in the research we've been doing for this report that I mentioned is coming out in December. There's been obviously a massive outflow of private capital, and it sort of halted the FDI inflows into the LDCs in particular that we've been looking at. And as Martin mentioned, the research shows, and from interviews and everything that's been done, the DFIs are supporting their own portfolio right now. So some of the questions that are out there are, number one, it's hard to tell if some of the amounts that have been announced are actually new capital or if it's been repurposed from other projects. And then so far we've seen in the short term, at least, that it's really been about addressing the existing portfolio rather than doing new blended finance projects, which we think is probably understandable given the short and immediate term needs that were there. And so we've been looking now at thinking, okay, in the more medium to long term, what can be done? And a recommendation that we have is that we need to make sure that the sustainable, resilient pipeline is being built right now so that when that time is ready for these new investments to come through, that they are promoting a economy and a society that is more resilient and more able to sustain the next shock. I'm sure that you've heard that the UN Secretary General has called for building back better. And so it is in that idea that we need to make sure that we can prevent or help be able more ready to respond to future disasters and shocks.
Great. Admasu, I think we have you on the line now. So I want to turn to you and both hear from you about what you see as the impacts of COVID-19, but also wanted to ask you this question about helping to mobilize institutional investors and particularly local investors. I know it's something you've been able to do at TDB, both in your investment vehicles, but also in how you're structured. So if you could talk to us a little bit about how you've managed to do that, how you overcome some of those barriers and what the impacts of COVID-19 have been, that would be great. You are muted.
I hope you can hear me now. Excellent. Sorry about the technical difficulties. The Wi-Fi was very weak. Yeah, TDB, as you've noted, has had quite a bit of success in crowding in private capital, specifically institutional capital, into not just transactions, but also into special purpose funds and into our own capital structure as a bank. We really reached out to pension funds and insurance companies, tried to give them that confidence that coming into transactions alone wasn't going to give them the diversification that they needed sometimes. So what we felt was if we opened up our total portfolio to them through a capital investment in a specific segment of our capital structure, that would give them the comfort that they would be benefiting from both diversification, but also, of course, the comfort of having a multilateral wrap around their capital. So this is a little bit of an innovative approach that we've taken as a regional DFI. And of course, we've made sure that we gave them a risk return value proposition that was attractive enough to get them to come in. And we've had almost 12 different institutional investors now come in. Most of them are local, and they've actually been quite pleased. Several of them have recapitalized their dividends, and they've actually managed to help introduce other institutional investors to come in as well. So that's really in broad strokes what we've managed to do.
And I guess building off of that, Admasu, so you've managed to do that. A lot of people are trying to sort of crack the nut and figure out how to do more of that. So when you look at trying to mobilize more institutional investors, or bring them into your business, bring them into some of these deals, what advice would you have for folks who are trying to do this?
Well, I think first of all, what becomes very clear is the value proposition has to be in line with what institutional investors are looking for. And then, of course, there needs to be track record, because I think sometimes what happens is there's a lot of advocacy that goes on, but then it's not very easy to follow through. So what we've done is we managed to bring one or two in to start, and when we use them as our ambassadors, because we demonstrated what we were able to deliver to those specific early stage investors. But what we also managed to do is to get the sovereigns and the original classical owners of our bank to create room for institutional investors, to create board seats for them, and to allow them to participate and get that blended return and risk exposure in a manner that gave them that confidence that they're real participants in the institutional model. And I think that really helped them come through, because they discovered that having a seat on the board and having a full level of participation in our governance structures gave them that additional confidence.
Great, thanks. Another question I wanted to turn to, which I think is, a strong debate that goes on, is, when is blended finance the right solution and when is it not? When is it sort of what we're supposed to finance? And Nadia, maybe I'll turn to you first on this. Where do you think blended finance can and should be deployed?
Blended finance is a great solution when you have market inefficiencies. So in the clear example that you're hearing, I think one after the other, is where we have perceived risk and actual risk being different, the knowledge, the lack of track record. Where you have a lack of track record is where you really need lending. The more track record you have, the more you have the ability to price in risk. it is not that institutional investors don't want to be in emerging markets and in the least developed markets, they don't know how to price it, or they price it at a level at which the projects just don't work. So the more we have lack of track record, the more blending we would need. I think over time, what we'll see is that what we see at the moment at the portfolio level, having equity investors coming or first loss investors coming in, over time, maybe a different type of investors are going to be coming in. Rather than donor capital, maybe we will see hedge funds or family offices or other type of impact investors that come into this rather than public capital. So blending when we don't have a track record.
Great. Laura, do you want to jump in on this one too?
Yeah, absolutely. I love this question. This is something that I'm a huge fan of blended finance and love talking about and writing about, but I don't think it's like a panacea for all development finance projects. Martin mentioned this already. You need to make sure that you are achieving the minimum concessionality, that you are not crowding out the private sector, that you are not distorting the existing market. So that means that there's a place where it's not the right tool. And we also know that ODA is, or overseas development assistance, is finite. There's a limited amount of this scarce, important concessional resource, finite and perhaps even declining in some places. And so it needs to be used in the smartest way possible. So with that in mind, I think this is sort of another way of looking at the portfolio approach, is that donors who have this really important concessional finance think across all of their investments, where can they actually get the most impact for the use of their concessional finance. And it might be true that the pure concessional in a grant might be needed somewhere, and that's where that should be used. And then blended finance should actually be a different project somewhere else, and that you don't want to actually confuse the two. And so it definitely takes a lot of analysis of these projects. But I think that, as Nadia mentioned, one of the risks in terms of track record is very important. And there are others, but again, I think that there's definitely a time and a place.
Great. Martin, do you want to jump in on this one too?
Yeah, thanks. This is the core question. And to reiterate, marketing efficiencies, those could also be related to externalities that aren't captured by a project. And historically, climate, renewable energy received a lot of blended finance. Today, people are talking about using it for battery storage projects. The other is in countries where there aren't really well-developed markets, and that's the less developed countries. And so blended finance structures or facilities that focus on those markets, like the IDA private sector window, is another way to ensure that funds are being used properly. But even in a less developed country, you might have some with more developed markets than the others. So you do need to try and differentiate. And just to add, when should one not use? And I was having a conversation with my team earlier today, where it seemed like our investment colleagues wanted to try and provide financing to a client that met the client's needs and other sources of financing that were available in that market. So we should not be using blended finance to help compete into a project where there's available funding. And we use that word market distortion as a way to talk about that, but that's what it is, and we should not be doing that.
Great. I want to be sure that we bring in some of the questions that have come in from our audience. And we have quite a few questions sort of about how to make blended finance work, particularly in LDCs. But one of the questions that we got is, that often blended finance vehicles are looking for investments in large companies, including in LDCs. And so the question that we have is there a way to sort of tailor blended finance tools to SMEs, to these small and medium enterprises? And I don't know, Nadia, do you want to jump in on that one?
And one of the best ways we have seen it is working with local financial institutions who then channel in the funds to these entities. From an institutional investor perspective, the best place to be is on the ground, and those financial institutions are on the ground. You can have purpose proceeds and so on and so forth to make sure that this money are channeled in that way, and then monitor. That's the best solution that we have found, that we blend at our fund level so that we ensure that we invested in many financial institutions on a portfolio basis, that then has a portfolio of SMEs, and we monitor the performance of those.
Great. And to follow up, we had a question that was really asking about, is there already sort of a proven way to build out portfolios of those small companies? Or do you see a need for more research on how to create sort of those portfolios of small companies? Martin, did you want to jump in?
Yeah, so we've developed a couple of years ago what we call small loan guarantee program, using funds from Aia-Eza as a first loss structure. And we've already got over a dozen, almost 24 risk-sharing facilities that IFC has set up with a number of banks, mostly across Africa, but in Haiti and in Asia, trying to do exactly what Nadia said, and I agree completely with her, is for these SMEs, local institutions or microfinance institutions are the medium through which one can address the problem. And these first loss guarantee structures are ways to help de-risk the provider of a guarantee, the risk share facility like an IFC, but many others do this similar structure. And we're still learning, so this seems to work. It seems to encourage financial institutions to lend. What we're seeing today in the COVID crisis, though, banks are quite liquid and are unwilling to take the risk of SMEs. And we're hoping that this product can help with that flow. So it's not a funding need, but more a risk mitigation kind of structure.
Great. And we had one question come in following up on when Nadia was talking about the GEMS database earlier. And that question is really, what are the blocks to that? IFC, I believe, participates in the GEMS database. So, what would it take for IFC to go in and advocate for the GEMS database to open up? Are you willing to, share more of that information and your track record so you can crowd in other investors?
So let me say, with respect to the topic of transparency of information, it's very important. And on the topic of blended finance, IFC is the one of very few institutions disclosing on our public website when we use blended finance and the level of subsidy. So every single project that's supported by blended finance, you can now sort on our disclosure page by projects supported by blended finance, and you can see the level of subsidy. I'm not so familiar with the GEMS topic and issues behind that, but transparency is important. I agree with Nadia, and it helps reduce perceptions of risk.
Great. And
if I may, I would just add the importance of transparency also goes to the previous points on track record, because as there's more and more transparent data available about existing investments, whether they've been wildly successful or less so, that will show the impact, which shows the track record and that these are actually can be good investments and sort of like a demonstration effect, but also then is the track record that's needed to sometimes incentivize investors to come in.
Great. We've got a few minutes left, but Admaso, I want to come back to you. We had a question come in about integration between global financial institutions and regional and local financial institutions. I know you're, quite involved on the African continent with local DFIs and trying to strengthen and, looking at how they can be strengthened. And so I'm curious, how you think global financial institutions can be better integrated, what sort of support local DFIs need in order to, help accelerate blended finance and sort of do their jobs better.
Yeah, well, I really wanted to just point out that for the first time this year, we have managed to bring on board a global institution. I think Martin is here. I think the World Bank Group came through to partner with TDB in a way that's never happened before. Many of the big global institutions don't seem to historically have had much appetite to work with regional and national or sub-national DFIs. So with this year, we actually began a very exciting program, both with the Aida window of the World Bank, but also with MIGA. And MIGA was able to give us a special product that enabled us to actually raise money from the capital markets, actually from the banking markets, right in the heart of COVID. And that was something that was very useful to us because it was a kind of capital raising, fundraising that would not have been possible to the same quality of the fundraising that we managed to do. So I think there is now more and more examples. Work very well with the KFWs, with the AFDs of this world, the European investment banks, but those are classical credit lines. I think what we need to see is some of these very interesting concessional pools of funding being opened up to African financial institutions who can actually also extend their reach to the last mile, push out the tenor, but also take a little bit more risk and not have all these big global funds and regional funds within Europe just being held by one or two institutions, because that really limits the ability to intermediate that type of special purpose funding. So we're beginning to see some movement in that regard, but I think there is a need for a little bit more flexibility in those funds. An example would be the EU Infrastructure Trust Fund. It's a very large fund, for instance, that is being used in some ways to blend, but also to deal with some of the rigidities and the gaps in terms of getting projects prepared and getting the feasibilities out and all of that. So I don't think we've had enough access to those types of funds. And I think as everybody starts putting more premium on the last mile, I think that there needs to be a lot more appetite to work with regional and national institutions to actually leverage this kind of money.
Great. So we've got 1 minute left. So I want to go just really quick to each of you. What is one thing that you think needs to be done for blended finance to be scaled? Nadia, let's go to you first.
Disclose the GEMS database.
Laura?
Keep the focus on the last mile with regard to the risks that needs to be mitigated as well.
Great. Martin?
Transparency on the level of subsidy when used with blended finance.
Admas?
Open up the pools of funding to the last mile players like TDB and the national development banks.
Great. Well, thank you all so much. This has been a great conversation. There's obviously lots of room to keep the conversation going. And I know I'll be in touch with all of you moving forward as all of this develops. So thank you all again for joining us. And now I'll hand things over back to my colleague, Catherine, for our next conversation on inclusivity in the investment space.
Thanks so much, Adva. Great session. So we've acknowledged how the COVID-19 pandemic has changed the nature of the conversation we're having today. But what we haven't yet discussed in detail is what this critical turning point in the fight for racial equality means for the future of development finance. And in this session, inclusivity in the investment space, moving beyond gender equality, we'll tackle that topic head on. We're going to kick things off with a video from our partner, FinDev Canada.
Hello, everyone. My name is Anne-Marie Lévesque, and I'm the head of Gender and Impact at FinDev Canada. We truly live in unprecedented times. We have long been fighting for the greater inclusion of women in the economy, trying to enhance gender equality, whether in pay, working conditions, opportunities for advancement, or mutual respect. One of the crises we recently faced was a worldwide confrontation with racial inequality, systemic racism, and other types of inequalities. This came with a consciousness that many women live in society facing the intersection of multiple inequalities because of their gender, race, disability, sexual orientation, or other factors. The development finance space is not immune to these challenges, and we wanted to bring to the Devex conference a discussion about how development finance institutions are confronting gender inequality and its intersection with other types of inequalities and discrimination. A great discussion is planned, and so I'll leave it to the moderator to introduce everyone. Thank you for joining us, and have a great panel.
So I'm thrilled to be joined by two experts on this topic with really unique insights on exactly how DFIs are confronting, as you just heard, not just gender equality, but its intersection with other types of discrimination. Jessica Espinosa Trujano is chair of the G7's 2X Challenge. You heard a little bit about that earlier. It funds women's economic empowerment in low and middle income countries. She's also the global gender finance lead for DEG Invest, which is the German Development Finance Institution, part of KfW Group. And Lade Araba is managing director for Africa at Convergence, which also came up earlier. It's the global network for blended finance and generates blended finance data and deal flow to drive private sector investment to low and middle income countries. So to kick off this conversation, I want to acknowledge that part of the problem here is the lack of diversity in the private equity investment space. And Lada, I know this is something that you can speak to. This sector, and I know you've said it before, and we all see it, it's largely white, male, and privileged. And I want to start by asking, what impact does that have on investments in low and middle income countries? What progress is being made here and what more is needed?
Thank you so much, Catherine. It's an absolute pleasure for me to be here having this really important conversation with you and Jessica this afternoon. I actually wouldn't limit this issue to just private equity. I think we see it across the entire capital continuum and the entire investing life cycle. We do know that there is an economic cost to racial, ethnic, and other types of exclusions. It's been researched. There's data that speaks to the actual dollar figures. And I want to throw some out using the US as a reference point, because there are parallels, with the African context in particular. So Citi has done some work researching this, and they have observed that about $13 trillion of potential business revenue has been lost as a result of racial, ethnic exclusions, potentially 6.1 million jobs that could have been created as a result of these companies if they had received the investments. And we do see this similar type of economic cost in Africa as well. Unfortunately, Black African founders, entrepreneurs, and even fund managers tend to be over-mentored but underfunded. So they're not seeing as many checks being written. They also don't have as much runway as their foreign peers to really be able to build and grow their companies and businesses. When they do raise, we're seeing that they're raising, smaller tickets in comparison. And unfortunately, they're often judged a lot more harshly than their foreign peers. We are having, however, starting to see, a recognition of this problem, which I think is a first critical step in the right direction. There's also the realization that oftentimes there is an unconscious bias that might be racially or gender driven or driven by other factors as well. And this does have an implication on sort of the investment policies and actions that are taken by investors. We also know that investing is oftentimes relationship based, and that local founders may not necessarily fit the mold that investors would recognize, the patterns that they would typically recognize. And investors are applying the similar strategies that they would in their home countries. And so as a local founder without those pre-existing relationships, or who doesn't quite fit that mold, it is easy to be overlooked. Now, having said all of this, we are starting to see some positive steps in the right direction. One is, some investors are applying negative screens, where they're looking specifically at some of these issues, whether there is diversity and inclusion in the workforce, in compensation, in the executive team, on the board. They're also actually implementing caps on investments that are made into companies that don't have that diversity and inclusion. We're starting to see alternative products that also provide more flexible terms in order to better accommodate the unique needs and some of the constraints facing local founders. We're seeing an avoidance of some of the discounts that would typically apply to local companies when they're being, when you're doing the valuation, if they are not tied to specific risk factors, and if effectively they are measuring some of that unconscious bias towards these local founders. And then also, just even more specifically, a flexibility and an openness to first-time fund managers, to female founders, and basically to entrepreneurs who do not fit that stereotypical mold that we've seen historically.
Now, you mentioned female founders, and I want to dive into that topic even further. I know that's something Jessica can speak to. So Jessica, you've written about how companies founded by women receive less than half as much funding as those founded by men, even though they deliver twice as much revenue per dollar invested. And again, just being frank about it, the big reason for this, or a big reason for this, is discrimination. And so my question for you is, beyond just driving more dollars and offering access to capital, how can investors try and tackle some of these more cultural and structural barriers? And maybe you can point to some of the work you're doing on that very topic.
Yeah, happy to. So as you both described, these gender gaps are shown time and time again by studies in different contexts. So really, it's really a global issue. And what is very interesting is what Lari mentioned earlier, that this flawed decision-making is really often unconscious. So one place to start is unconscious bias training, which several 2X members are promoting among their investees. The other thing is capacity building to help financial institutions, fund managers, and capital providers to be able to expand their focus on women entrepreneurs and to serve their specific needs rather than just coming with a cookie cutter approach, trying to offer products that may not even be relevant for them. And I think the second really important factor is the composition of investment committees. So investors tend to have a bias towards entrepreneurs that are similar to them, which leads, for example, to the absurd situation where Silicon Valley VCs invest in Africa, but not in African entrepreneurs. And so investment committees should be as diverse as the universe of entrepreneurs out there. I think that's a huge lever, and this is where investors and also those who fund those private equity funds, for example, can really play a role in making sure that ICs are more diverse. It's also very striking what Lari mentioned, that female fund managers and also African fund managers often face the same barriers and the same kind of discrimination as female entrepreneurs. So it's really perpetuating this vicious cycle of discrimination. And so I think if we as investors want to move the dial, we have to overcome those structural barriers facing female fund managers, especially in Africa. And as Lari mentioned, this also means that we should reflect upon our historic investment criteria and see what those barriers are and what we have to do to overcome those challenges and to make fundraising for these fund managers possible.
And I hope you can tell us a little bit more about the 2X challenge. So it came up earlier. Andy Herskowitz mentioned it as a positive example of how to move the needle, as you said. So do you think that this issue that 2X is working to address is getting enough attention globally? And how is the 2X challenge specifically trying to change that?
So the 2X challenge was launched at the G7 summit in 2018. And we collectively, as DFIs, made a bold commitment to mobilize and commit capital with a gender lens. So to make investments that specifically benefit women in emerging markets. And we set ourselves the ambitious target of $3 billion by the end of 2020. By the end of 2019, we had already significantly surpassed that initial target and had collectively committed and mobilized $4.5 billion with that specific focus. So I think that really showed the business case. And because of that success, there's now also a lot of attention to the business case, to this priority globally. But so far, I think investors have mostly integrated a gender lens into their traditional way of doing business. And that's also really important because there's still so much that can be done. But looking into the future, I think it's also important, as I mentioned, to reflect upon our traditional approaches and to look at the market and what else is needed to move the needle. And so within the 2X challenge, we're currently discussing and developing this 2X flagship fund concept, where we want to make sure that we specifically look at the challenge of fund managers and promote diversity and inclusion, both at the fund manager level, but then also at the investee level and the investment strategy.
So I want to bring in a question around data, and we only have a few minutes left, so let's try and keep responses brief here if we can. But you've both pointed to how this is not just the right thing to do, but it makes business sense too. And my question for you is, if your call to action is We need progress in this space. Data is how we track that progress. So how exactly can investors look to data to understand the opportunity here and also track progress when it comes to gender equality and racial justice in this space? Quickly. Either of you want to jump in?
Sure, I'm happy to start. So the great thing is the research has actually been done, and we've seen research from a number of credible sources. One example is that McKinsey has noted that there are higher profit margins for companies that are more racially and gender diverse. They've also noted that the companies that actually fall within the top quartile are able to improve their overall financial performance by about 35%. That's not an insignificant percentage. There is a linear relationship ultimately between diversity and also the overall financial performance. They further noted that there's a 10% increase, with a 10% increase in racial and ethnic diversity in companies, especially within the senior executive teams, that EBIT, earnings before interest and taxes, actually increased by about 0.8%. So basically what these stats are telling us is that there is an economic rationale for wanting to create more racially and gender diverse companies.
So we're almost out of time here. Jessica, I'd love to end with you, and I hate to put you on the spot, but I want you to share a lesson learned, right? Because our mandate in this session is to talk about inclusivity in the investment space, moving beyond gender equality. You have been very focused on gender equality. I know you live it and breathe it day in and day out. What is one lesson you have learned that as we move beyond gender equality, it's still a fight we have to fight, but address inclusivity in all its forms across gender, race, and geography? What's one lesson you've learned that can be applied?
So let me link that back to the question of data. I think data is absolutely vital, but we also have to be cautious that we don't trick ourselves and just tick boxes. And so we have really, a key learning for us was to really look at intentionality and to look at the way companies value women and how they value diversity and inclusion. So it's not just about counting, it's really changing cultures and mindsets. And especially now looking at broader diversity and adopting an intersectional lens. What we have learned is that it's important to adopt a power lens. So not just to collect more data, women that tick more boxes, but to apply a power lens that's context specific and that really helps us understand how there are power dynamics in investment structures in local contexts and how we have to challenge those dynamics to make a real systemic change and to enable, at the end of the day, social justice.
Thank you for that. We can't talk about inclusion without acknowledging power. So I appreciate that powerful point. And with that, I will hand it over to Adva. Thank you both.
Thanks, Catherine. Next, I have the great pleasure of introducing Sir Ronald Cohen. And he is the chairman of the Global Steering Group for Impact Investment and for the Portland Trust. But he is also very well known as a pioneer in the finance space, really helping to make huge changes in venture capital, in helping to create social impact bonds and much more. So Ronnie, welcome. I'm really excited that you could join us today. It's always a pleasure to speak with you.
Likewise, Adva. Pleasure to be here with you and with all of you on this amazing webinar.
Great. So I wanted to start by asking you a question about an issue that you've been working a lot on recently. And you're someone who's, a big thinker. You believe strongly in the ability of capital markets to change. And you have been spending a lot of time working on this concept of impact-weighted accounting, of looking at how, changing the way financial markets measure performance so that impact and, how they do financially are both measured. So tell us a little bit more about this idea of impact-weighted accounting and, how realistic is it to actually get capital markets to implement it?
So the answer, Adva, is that it is so realistic that it is already happening. If you look at the $30 trillion of ESG funding, they have already tilted the financial scale for companies. The Harvard Business School Impact Weighted Accounts Initiative, which I'm privileged to chair, and I've just come off a 2-hour meeting with all the people involved in it, has published the environmental damage caused by 1,800 companies across the world. And when you analyze this data, you see that within the same sector, companies which pollute more are worth less relative to their competitors. And I believe that as impact transparency comes through impact-weighted accounts, we're going to see these correlations emphasized, and we're going to see investors beginning to draw correlations with new variables about future growth and future profitability of companies that deliver impact as well as profit. Now, we can measure, and anybody can go, it's open source to the Harvard Business School IWA, Impact Weighted Account site, and you can see that we already show how to measure, and we show examples of the operational impact on the environment, which I've just described, but also employment impact, connecting to the conversation that just ended before we began. You can measure diversity. You can measure gender parity or lack of it in terms of pay or other benefits or even advancement. I encourage you all from the last session to go to the Harvard Business School site. You can put monetary values on them. You can take the missing representatives in terms of gender or minorities at different echelons of a company and apply the salaries they would have or wages they would have earned and get a sense of the loss to their community from it. So the answer is, Adva, this is the next frontier, not just for capitalism, but for society. And I believe it is now becoming inevitable because if impact information is price sensitive, then regulators are going to have to mandate transparency.
So you brought up this idea of regulators, and I think obviously this varies by country and by region, but what is the role of regulators? At what point do you have to have additional regulations or government input to sort of force markets to adopt this? Obviously, there may be some leaders who will do it on their own on a voluntary basis, but do we need sort of regulations to require this of everyone for markets to truly change?
So I'll give you an illustration of why regulators have to come in. We've published today the accounts of, or at least we have the accounts, but we've published the environmental damage caused by 1,800 companies. And incidentally, 250 of them across the world deliver more environmental damage than they make in profit in a year, Adva. There are mind-boggling figures in there. These 1,800 companies' figures had been published by the companies. They weren't audited numbers, but 80% of the necessary information had been published. We're about to publish several other hundreds of companies. And the level of information is going to be lower than the 80%. And so you're going to have investors trying to make the investment decisions without having equal information from all the companies involved. So this isn't about regulation bringing increased constraints on the ability of business to operate. This is regulation that brings transparency to investors, to consumers, to employees, and to governments, so they can all make better decisions.
I wanted to ask you a question about the impact of COVID. Obviously, this year has changed a lot of things. And so I'm curious how you've seen COVID shifting some of these conversations around markets. We are seeing sort of an uptick in interest in sustainability and sustainable finance and ESG investing, which we talked about a bit earlier. And so from your perspective, how is COVID accelerating that change? How is it impacting some of those dynamics that were at play before the crisis?
I think it's accelerating, and it will continue to accelerate the change, Adva. The reason is that, first of all, COVID shakes our habits and beliefs and is leading to a lot of questioning of our system and our political system, as well as our economic system, and this opens the door to greater change. But if you think about it, all our governments are going to emerge from this crisis with less resources to spend on increased social issues arising from high levels of unemployment. Because governments have had to borrow to try to help individuals and companies through the economic crisis. And so the only way that governments can cope with the challenges that are going to arise as a result of sustained higher unemployment through poverty, greater homelessness, and so on and so forth, is to bring companies and investors to their side to bring solutions to these challenges. Instead, as we've been doing for decades now, companies creating, in their pursuit of profit, huge consequences environmentally and socially, and governments trying to tax us all to try to remedy them.
Ask you a question, because we've been talking about, sort of really big picture issues. And I think one of the concerns from folks in the development community is we see some of this acceleration is that, much of this new investment is happening in the world's richest countries. And so I'm curious, what mechanisms you think are needed to ensure that these investments have an impact in the world's poorest countries, that the world's poorest countries, that sort of this, development finance isn't left out of this emerging trend in financial markets.
So what impact transparency is going to do, Adva, is lead to businesses being judged. And this will affect their value on the stock exchange, not just on the basis of their profit performance, but also their impact performance. Now, if you think of their product impact performance, the greatest product impact performance will come from beneficial products that help underserved communities. And so one element of the advantage that impact investment is going to bring for emerging markets is that companies that begin to provide products to help communities in emerging markets with more appropriately priced and designed products will see it reflected in their impact-weighted financial accounts. The same will be true for their employment. To the extent that companies are creating jobs in areas of high unemployment and high poverty, as often is the case in emerging countries, that too is going to be reflected in their numbers. And finally, it is going to help emerging markets to somersault through the use of technology some of the environmentally damaging operational models that developed countries have historically followed, because the sale of these products in these countries will bring impact advantages measured in dollar terms or in currency terms to the companies that are supplying them. So I very much hope that the result of impact transparency, of impact accounting, of reflecting impact through financial accounts, will be to direct a greater investment flows and product flows and employment flows to emerging countries.
So to follow up on that, a lot of the sort of, research and information being done at Harvard that you've been a part of is about some of, 1,800 really, really large companies. So when you look at, a small or medium-sized company in an emerging market or a frontier market, how does this apply to them? How do they play on the same field when they don't have the same sort of resources to do the same type of measurement or reporting? How do we create a system that allows them to not be left behind of this evolution?
Well, so first of all, I think coming out of this crisis, the emphasis is going to be on small, medium-sized growth businesses and self-employment in order to absorb the huge number of unemployed back into the workforce. The reason is that an unfortunate consequence of COVID is that big businesses have shed labor and they've learned to operate on a streamlined basis, and they're going to try to hold on to that. So the incentives have to go to smaller businesses. Now, I think in terms of impact, the employment impact will be easily measured. The product impact may also be quite easily measured. It shouldn't impose a heavy burden on a small business to prepare impact-weighted financial accounts. And just as we have slimmed down financial accounts, then we will have slimmed down impact-weighted financial accounts for smaller businesses.
Great. Well, Ronnie, thank you so much for your time, and looking forward to seeing how this evolves and how it's picked up by financial markets moving forward. Such a pleasure to have you with us today.
Fantastic. Thank you very much, Adva. Bye.
Great. And so next up, we're moving to a conversation. We've talked about sort of financing in the COVID era broadly. And in this next conversation, we're going to dive deeper into how, innovative finance solutions can be leveraged to address critical global health issues, particularly in this time of COVID-19, particularly as we look at issues of vaccine access when a vaccine is available, and access to other, critical needs in this time. And joining me on this panel are Guillaume Grasso, who's the Director of International Business Development and European Strategy at Gavi, the Vaccine Alliance, Thomas Opio, the Country Director for Kenya for Living Goods, and Dr. Nithya Ramanathan, who's the CEO and co-founder of NextLeaf Analytics. Thank you so much for joining me today. Guillaume, let me turn to you first. You've been helping lead Gavi's work on COVID financing through the COVAX facility. And I want you to tell us a little bit about some of the mechanisms, some of the innovative finance tools that you're using to help low-income countries secure vaccines. And Gavi has done this in the past. You've done advanced market commitments before. What have you learned from those experiences that you're bringing to bear now?
Thank you, Adva, and I hope you can hear me well. Hi, everyone. Indeed, you're right. Gavi was created in 2000 on the premises that you would need to go beyond classic finance to solve problems in global health. And so from the beginning, we put together some large innovative financial instruments at scale. And I think most of you have heard of the vaccine bonds, for instance. We call that IFIM. And what it does is that basically we use markets to issue bonds to get money upfront to buy vaccines. And then this is repaid against long-term donor commitments. One of the things we've been doing from the beginning is looking at innovative finance at scale. Really, how do you make a big impact with those tools? So for instance, the vaccine bonds, we've raised $6 billion since the beginning of the experience in 2006. So when COVID-19 hit us, and of course, the international community came to Gavi and other agencies to say, what are you going to do? You need to accelerate a vaccine. We need an answer that has to be available as soon as possible. Well, very naturally, we looked at our toolbox. What kind of innovative financial tools do we have? What can we use off the shelf, so to say, to address those new needs? We had created in 2009 a tool called the Advanced Market Commitment, which at the time was to accelerate a vaccine against pneumonia. And that worked pretty well in terms of getting it at a low price very quickly to developing countries and in large quantities. So we took that tool, we twisted it a little bit, we tweaked it, and we put it together to create what is now known as the COVAX AMC, which is the big international answer. And our goal is to use this instrument to bring 1 billion doses of a COVID-19 vaccine as soon as possible, and hopefully as soon as January next year.
And to that front, I think COVAX has just signed a new letter of intent today. I think you made the announcement for 200 million doses. So it sounds like you're well on your way towards that goal. Nithya, I wanted to turn to you. Your work focuses on supply chain strengthening and using data to do that. What are the key barriers that you're seeing today in the COVID-19 response, and particularly in terms of what's at stake for future vaccine delivery? What are some of the countries you're working with sort of most often asking for, most often struggling with?
Yeah, that's a great question. So if I take a step back, the COVID-19 vaccine presents a number of challenges to supply chain. So it is, in terms of the scale, the most unprecedented vaccine distribution challenge that countries have faced. For example, in Kenya, one of the countries where we're working, the Ministry of Health has talked about how the largest vaccine campaign they had undertaken to date was a measles campaign for children under 15. So now we're talking about trying to leverage the existing supply chain for routine immunization, which has been designed to serve children, and flip that around so that we can reach the most vulnerable healthcare workers, a completely different segment of the population.
Thanks. Thomas, I want to bring you in, and Nithya mentioned Kenya. That's where you're based. What are you seeing in terms of the financing gaps right now? I know you have a private sector background. How do you think the private sector can sort of be brought in as partners in this effort?
Thanks, Adva, and thanks to the audience. I think there are multiple levels of challenges, and I think the biggest gap really is around making the money available. Back to what Nithya was saying, if you look at the bare volumes, sheer volumes that are needed and relatively quickly, so it doesn't need you a lot of time. You don't have a lot of time for forward planning, but compounded with systems where governments are inherently under-resourced, and also health is also deprioritized, so it brings that complex around it. So I think the bigger question is, how do we get to focus on that as a priority and coordinate it through government? Because also, if you look at the levels of scale, and also looking at also the discussions of the previous presenters, all countries are a threat, so you cannot depend on somebody else, so that you can raise financing for this. In terms of private sector, I think it's going to call for a lot. I remember Richard talking about impact-associated financial mechanisms, P&Ls. I think maybe the sooner that was brought in, the better, so that all companies in different perspectives, not just in health sector, start looking at it in that approach. And then we see how much more they can invest towards a common cause like this, maybe for now. Yeah.
I'd love to jump in on that, actually. Do you mind, Adva?
Yeah.
Yeah, I really like what Thomas was bringing up, and it raises, I think, a few other really important things here. So if I take a step back, one of the challenges in financing for global health historically has been that it's been very top down and not a lot of flexibility for the realities on the ground. And exactly as Thomas is bringing up, country governments and countries' ministries of health are really at the center here of the storm. And one of the things that we're starting to see, for example, in the context of Gavi health system strengthening funds, is that there's more flexibility. And we're hearing that from ministries of health, that the way that the financing is structured is very intentionally designed now in the context of COVID to give countries the flexibility that they need to respond. A second point I wanted to raise here is around private sector engagement. So what doesn't get discussed, I believe, enough is the real challenges that ministries of health face in engaging the private sector. So it's not just about getting the flexibility of financing, but also there are very real concerns that ministries have in terms of transparency of pricing, as well as accountability. You know, one of the early lessons we learn in business is don't expect responsibility for something that you don't have control over. And so as we transition to this new model where ministries do have more control, we also want to look at how can we kind of flip that relationship between ministries of health and the private sector so that ministries of health have more visibility, have more ability to manage the performance of the private sector and really demand what they need.
Great. Yeah, I want to bring you back in and picking up on what Nithya was saying. I mean, governments obviously have a really critical role to play in this, not only in their coordination capacities, but they also need to dedicate more resources to these issues. I think we've seen governments, particularly across the African continent, despite sort of commitments to dedicate certain, thresholds of funding to health, that those have often not been met. Gavi works very closely with governments, and you often, are trying to help these governments find a way to transition off of Gavi support eventually, and sort of to build up some of those institutions and structures within government. So tell us a little bit about what you're seeing in those efforts, how governments can sort of be encouraged and incentivized to really invest in global health, and where they might be better educated about how they could leverage their capacity to bring in other financing and what sort of tools they might use.
This is so true. And actually, that's one of the lessons actually from our experience practicing innovative finance is that, the immediate thing you would think about when you say innovative finance is obviously finance, right? It's getting this money, additional money into the programs, and how do you leverage maybe non-traditional funding sources. But we found that it's got many more virtues than just the money. And one of those virtues is sustainability. So it's exactly what you're saying, is how do you construct an instrument that will at the same time leverage additional funding, but also propose this kind of long-term vision where you can bring the industry in the long term. In the case of a COVAX AMC, for instance, what we're trying to do now is making sure that the industry will make the upfront investment and will be there in the long term to provide the vaccines. And while we're doing that, how do you at the same time ensure that countries themselves take a share into that, and that share will grow until eventually there will be full sustainability. Now, we've seen that in the past with Gavi, and you're right to mention it. We have this transition policy, which means that countries, as the GDP increases, their share of the funding will increase. We don't call it innovative finance because we call it just finance. We think it's how it should be. And at the end of a certain transition period, when the country is able, then they get rid of us essentially, and that's a very good thing. Now, that's how we build the innovative financial instruments that we bring. But I want to add one thing, which is also actually something that Nithya, you were mentioning earlier, which is that beyond all those aspects, there's also the aspect of skill transfer. Now, that I think is fundamental, because if you're sitting in a government chair, very often you have a lot of people that come to your door and say, we have fantastic solutions, and you might be a little bit overwhelmed to do the selection. You know what you need, but you're not sure how reliable the person you're talking to is and whether you should trust them or not. And one of the things we've been doing with innovative finance, with an instrument, for instance, like Infuse that Gavi has, is to connect an ecosystem of very powerful innovative solutions and a set of needs that are brought together by typically ministers of health in countries who know best what is needed. And by doing this connection, what you do is, of course, you bring the finance, but you bring the skills, you bring the solutions, and you set the path for those solutions very often to turn into, in the long run, commercial solutions that will be self-sustainable and that will be completely embedded into the government systems. So I think that's also a very important use of innovative finance.
Thanks. Thomas, did you want to?
Yeah. I wanted to jump in. I mean, into what Galum is saying. I think because what he's saying is very critical. Even as you're talking about just resource mobilization on one aspect, I think part of the real problem here is there's a lot of inefficiency and losses in between the system. So if how do you leverage on all those, both the what I call the problem side and the solution side? to integrate the two, to also improve efficiency so that you can actually, because if you talk about impact, really you can reach the highest numbers. I mean, just giving immunization as an example, you get the tons of antigens expiring somewhere else, and there are children who are going unimmunized at the other side. So how do you link that? And probably this is a play where things like technology, usage of data, for the real-time decision making comes in. But yeah, my additional comment to that really is also looking at approaches like the match funding that I'm sure Gavi is really known for. Yeah, how can we work with governments really to try and propagate that at the onset now for something like COVAX into the future? Yeah.
Great. Nithya, back to you just on this point on data and sort of what you think is needed there. And maybe that's what you were just about to jump in on, but I do think that can play sort of a critical piece in this. And also, as you're trying to make a business or investment case for health, that data is a critical tool.
Yeah, that's a great point. I was actually going to jump in on a different point, so I'll briefly touch on that and then come to your question around data and how it can actually close the loop here. So one of the things that's so important about what Thomas and Guillaume are both talking about is speaking to this dysfunctionality in traditional global health, where the payer has not traditionally been the actual customer. And so that's where exactly what Guillaume is talking about and Thomas in terms of this match fund that Gabby's launched and Infuse. What's been really powerful is that organizations like Nextleaf have been able to actually work directly with ministries and interface directly with ministries as the customer and behind the scenes, the payer, in order to build out not only that technology and skills transfer that Guillaume was referencing, but actually create more sustainable systems for the ministry to actually build the business case and actually procure these solutions. It creates a much less distorted market. So to your point about data, obviously I'm really passionate about that. That is, what we live and breathe every day. One of the things that we've been seeing is that real-time data, as Thomas was referencing, has been potentially a game changer here. And here's why. So we build sensor technologies at every level of a health system. And what we've seen is that in terms of aligning incentives, data has been critical. When everybody's looking at the same blueprint, when everybody's looking at the same game plan, we can all kind of come together and agree on the path forward. And that's what data has made possible. The second thing that is potentially making possible is this new conversation that we really want to start seeing between ministries of finance and ministries of health. If we really want to get serious about having countries invest in their global health systems, then that channel of communication between ministries of health and ministries of finance is critical. And data is going to really underpin that business case that ministries of health now have to make for what is the value, what is the return on investment, and making that business case for the spend in global health.
If I can come in, if you allow me, I just
yes,
wanted to come back
please.
because I think what you just said, Nithya, is spot on. And to Thomas' point, one of the big, incredible power, some of these innovative financial instruments is de-risking. It's de-risking for everyone. It's de-risking for governments who need to navigate the jungle that I was mentioning about earlier. It's de-risking for the companies themselves, for the entrepreneurs, particularly for the startups, because it can be pretty hard to understand the jungle from that side as well. And what you do with an instrument like the matching fund, for instance, is you bring funding that will be taking risk. And because that funding is taking the risk, that means others don't have to take it. And you test solutions and then you scale them. Now, it's an incredibly powerful model because it allows you to scale fast or fail fast. If it fails, you just get rid of it and you move to something else. If it works, then the power of innovative finance, like the matching fund, is that you can then roll it out country after country after country. And I think this is exactly what, Nithya, you've been doing, and Thomas, what has happened with yourself and with Living Goods and Last Mile Health. And we have now plans that will allow us, because it works, to go to scale and make a difference that matters in so many different settings. And that's only because we have those tools that take the risk and that de-risk the approach for governments and for the companies.
Great. Thomas, I wanted to go to you quickly because living goods is really known for your ability to reach the last mile. And so as we're talking about financing solutions, what do we need to be keeping in mind so that these solutions, aren't just to finance supply for folks in urban areas, for folks who are wealthier in a country? So I'm curious how you can share your insights and really sort of push people who are working in this field to ensure that that last mile is reached.
Thanks, Adva. I think, you raise a critical point. I think, how do we, and really, so when you look at even the need for vaccination, you generally find that there's an element where, based on the socioeconomics, the underprivileged are the ones who tend to be more, they're more vulnerable. So they actually have less, right from the onset, rules of nature. So how do you start by targeting? And I think the element here is really around how do you drive equity, but how do you target the most vulnerable? Because remember, even when you go into something like vaccines or any other service or product, once you can ensure that the most vulnerable is taken care of, the other people will take care of themselves in the food chain. So I'm sure when you start from that prioritization approach, then that's the place you need to target most, by and large. But then back to the broader health system, and when I look at it, and maybe more a bit of context of places like Kenya, you then need to be very conscious about the differences across the different ecosystems, and also co-create solutions with them, because also just tying it back to what Gulam was saying about sustainability, so that people also own the problem with you, but also as much as possible, how can you bring them in right from the onset, the authority and systems in those ones, so that you can walk with them through that journey. Because I think, then you get it more in a sustainable approach, because it's going to take a bit of a longer time to reach where you want to be. So those are key pieces that I think would be very critical. Thank you.
Great. We had a question come in, and the person says that, it asks the question, can you link performance outcomes to funding for better health? And they say, that they think that's sort of the key to innovation in this space. Is there anyone who wants to jump in on that? Nithya, do you want to?
Yeah, I'd love to. Oh, sorry. Go ahead, Thomas.
No, go ahead. I'll jump in after you.
Sorry. Okay. A couple of things about this. One, so I'm a big fan of performance-based outcomes. Results-based financing is another term used. If we do that too prematurely, we run the risk of creating negative incentives. In other words, that people, whether it's ministries of health, private sector, whoever the stakeholder is, not being honest about what's working and what's not working. And so objective data is critical as part of performance-based pay or performance-based outcomes. But really at the stage we're at, I would actually say that we need to be more incentivizing objective information sharing. I think Gavi, and this comes straight from Seth all the way through the organization, has been really critical in talking about how they don't want 80-page reports. They don't want BS. What we need right now as a sector, but what we need right now in the sector, if we're going to advance and introduce innovations, is actually authentic, objective data on what's working and what's not working. But absolutely, one of the things that we're working towards actually is a performance-based framework for countries to engage the private sector. So you put a sensor into a truck, a private sector entity says, I promise to keep this COVID vaccine cold from point A to point B. You've got a sensor. Now suddenly the government has objective data that says, okay, you've kept it at the correct range. We're going to give you this specific pay. You can start to quantify the value and return on investment. So performance-based outcomes is critical. But if we start there, we run the risk of not learning exactly what's working and getting to that next phase of scale.
Go ahead, Tom.
Good. Thank you. My only addition to that, I fully aligned with you. Actually, the only addition to it would be, how do you try, and even at the formative stages, institutionalize that at the last mile? I know you talked about the last mile of community. So if you look at maybe the health ecosystem, and back to what maybe Living Goods does, is really supporting performance management at the very elementary level down there. So if you want to talk about, let's say, vaccination, how do you drive that even the community health workers who will be reaching those houses, whether it's something like coverage or number of defaulters, trace and track, that the whole performance management process is institutionalized at the very basic level, then you can drive it up the whole ecosystem. Because I think part of the failures and challenges with some of this performance-based financing is, people want to look at it at a systems level, but then it may not have been operationalized effectively at the very, what I call, where the work actually does, it happens. So, yeah.
Great. We've only got a few minutes left here, about 3 minutes, but I wanted to end with a question. And we've talked, and actually you've sort of teed this up, Thomas, because you've talked not just about COVID-19, but global health more broadly. And so I wonder what lessons this crisis can sort of teach us about, how we look at innovative financing in global health more broadly, or if there's sort of an issue or a place where things need to be done differently in the global health innovative finance space, new mechanisms that are maybe needed down the road that this has brought to light. So I'll go to each of you for a sort of quick, less than 1 minute response. Guillaume, let's start with you.
Thank you. And I think, for me, there's a couple of very important points there. The first one is that the future is about scaling what works. So before inventing new instruments, we now have enough, experience with stuff that really works and works at scale. And we saw that with COVAX. What do we have on the shelf? How can we adapt it? And how do we make it work? So I think there's going to be a lot more of that. The second is that the future is about blending. And I think that's coming very strongly, for instance, with our COVAX work, where we have the AMC, the Advanced Market Commitment, which was recycled from our pneumonia work, and we're plugging this into our vaccine bonds. So we can use the vaccine bonds to use some of the money that we put into the AMC. So that sort of blended instrument, I think, has a very strong potential. The third one, I think, is that's going to be as much about finance as it is about the skills. And so we cannot underplay that, because especially in the times of COVID, what we will need, for instance, in the vaccines field is how to face the anti-vaccine movement, how to face the resistance to vaccine. When we get that vaccine, the worst that could happen is that we have millions of doses that could save millions of lives and that nobody takes them because of wrong or fake information. So we will need the skills, we will need the talent, we will need the data, to the point that was made earlier, to be able to make that case. And the final point I would say, which goes beyond health, is that whatever we've learned and that works, it is time to pass it on to other sectors than health. And I think, it's very powerful now that when I see the Education Commission taking our IFIM, our vaccine bonds, and saying, we're going to do IFED, the facility for education, modeled largely after IFIM. That means that we can breed success, not only for health, which is extremely important, but also for other sectors. And that's the way we will achieve the SDGs, because we just have 10 years. So we'd better hurry up.
Great. We're basically at time. So Nithya and Thomas, if you each have just one quick thing you want to add in about 20 seconds, I'll go to you first, Nithya.
Yeah, I think really quickly, de-risking. Guillaume's point was excellent. And what we're seeing, for example, in Tanzania, is that because the initial de-risking came in completely supporting the initial uptake, then the ministry is able to make that effective case and then actually pay and procure and sustain these solutions. So in terms of long-term change for a health system, I think that initial de-risking coupled with Ministry of Health sustainability afterwards is critical.
Great. Thomas?
Thank you. Last for me is basically, incentivize to have government at the table from the onset. Thank you.
Great. Well, thank you all so much for this wonderful conversation, and look forward to hearing more about the work as COVAX and all of your individual sort of work on this front moves forward. And now I'll turn it over to my colleague, Catherine, for our next session.
Thanks so much, Adva. So now we're going to shift gears to a topic that I cover quite closely at Devex, which is efforts to connect the unconnected. And there have really been all kinds of initiatives to boost affordable connectivity since the COVID-19 pandemic struck. These efforts have been ongoing, but I've really seen a surge of urgency and activity as so many essential services and conversations like this one move online. So in this conversation, we're going to connect these efforts to connect the unconnected to this topic of innovative finance. And one of the exciting things about this session, as you can see in the session title, Microsoft's Airband 1 year on, lessons learned, we talked about this initiative. We actually had some news about this initiative at this event last year in London. And so we're going to hear how it's going and what more is needed in this space. So I'd like to introduce our panelists. Shelley McKinley is Vice President of Microsoft's Technology and Corporate Responsibility Group. And Brian Kariuki is the Managing Director for Investment and Partnerships at Mawingu Networks, which you'll hear a little bit more about. So to kick things off, Shelley, those of us attendees who were with us at our Future of Development Finance event a year ago may be familiar with Airband, certainly are familiar with Airband, but can you tell us a little bit more about the effort and how it fits within a larger strategy at Microsoft to spread internet access? Because I know it's not just technical solutions, but working, for example, with development finance institutions as part of your strategy.
Sure, and thanks. It's really my pleasure to be here again at Devex, even if virtually. So hi, everyone. I won't say good morning, even though it's morning where I am. I know people are around the world watching this. So I guess good day to everyone. It was my really distinct pleasure to be able to come to Devex last year and announce our Airband initiative, our global ambition to cover 40 million underserved and unconnected people around the world by 2022. And so Airband is a larger initiative at Microsoft. We cover rural US, we cover urban US, we cover global connectivity. And so really the program itself is working with partners around the world to help them accelerate their efforts to cover unconnected people. Partners like Brian, who's on the call from Mawingu Networks in Kenya, partners all across really the United States and across the world. So we help with technology, we help with financing, we help with connecting, we help with technology that that can digitally transform communities and digitally transform the way people live their daily lives. You know, think about the opportunities you have once you get connectivity somewhere. To be able to do things like, I think the woman in the last session was talking about monitoring and managing vaccines as they travel across a country. Now you can do that at one endpoint and another endpoint, but imagine what connectivity can do to help you monitor and manage things along the way. So without connectivity, we don't have really access to what are 21st century technology pieces that really help us advance. Couple of other things that I do at Microsoft, this really underlies them. It's the foundation for the work that we do on sustainability. It's the foundation for the work that we do on helping people with disabilities work, live, and play like everyone else. It's really provides the basis of what is fundamentally Microsoft's mission. People ask me often, why is Microsoft interested in connecting people? Aren't you just a software company? And the answer to that is really, our mission is to empower every person, every organization on the planet to achieve more. And to do that, people need to be connected.
Yeah, it was interesting revisiting the conversation this time last year in London, because you and Raj Kumar from Devex were talking about why internet access is so critical and what would our life be like if our access was taken away. Flash forward to this year when the COVID-19 pandemic has certainly reinforced the need for internet access and this message that people who are disconnected will fall further and further behind. That's been very clear in recent months. So with that, I want to ask, how has the COVID-19 pandemic affected this effort that you announced on stage last year, connecting 40 million people by 2022? In some ways, has the pandemic accelerated that effort, or what's really the impact been?
So we'd be making the world's biggest understatement if I said that we are not in a fundamentally different place than we were last year this time. We all know it, we all see it, we all live it every single day. So much has changed around the world. There is one important thing that we're talking about today that frankly has not changed that much around the world, and that is the speed at which we are covering the world. So if you look at the latest statistics, what you see is, I think I said last year on stage that we had just about half of the world online. The UN announced the ITU's data just a couple of weeks ago, saying it's 53.6% of the people who have some access to connectivity. That is not nearly fast enough. So that is not changing. So I think about it as the virtual connection of people is not increasing as quickly as the physical connection of people is decreasing in these times. So that is a real challenge. what is done exactly as you've said is it has shown a spotlight on what happens when we have this situation. You know, every day you see kids can't do their homework, people can't access telehealth. Mental health issues in the crisis certainly are just exploding. And if people don't have access to internet, then they of course can't access their telehealth providers. So it's a big challenge. It's disproportionately impacted people who are already disproportionately impacted by internet. So you think about women, think about communities of color, you think about people with disabilities, those things. So that's a real challenge. That said, I'm really happy that we've made some significant progress towards our goal of 40 million people. So we're right now at about, we'll call it close to 17 million people that we, with our partners, have been able to help cover with internet access. And I do want to say that this is not something that Microsoft, goes out and rolls out networks by ourselves. We are very dependent on our fantastic partners to actually do this work. So it is something that we spend a lot of emphasis and time on, and given as I said, it's really core to our mission, but fundamentally the execution of this really is dependent on the amazing partnerships that we've been able to form with people like Mawingu Networks.
Well, that's the perfect way to transition to Brian here. So Brian, I'd love for you to describe what Mawingu Networks does. And quickly though, I'd love to just share an analogy because for those who are less familiar with the internet access space, years ago, I did an interview with the chairman of Mawingu Networks actually, and he provided this analogy that I thought was really useful. So I'd love to just share it in case it's useful for our attendees, and then get your reaction here a little bit more about what you do. So he described how internet access efforts are really look like this, right? The internet is like a highway and road system, and fiber, which we have big tech companies working on fiber initiatives across Africa. Fiber serves as a sort of superhighway at the country level. And there are investment opportunities for small businesses to set up filling stations that connect roads to one another. So do you think that's a useful analogy? And if so, can you also help us understand how Mawingu Networks fits into this analogy in this system?
Thanks, Catherine. That is an absolutely useful analogy. The situation in Africa is that 60% of people live within 25 kilometers of a fiber line. That makes them very accessible for people such as ourselves who are willing and able to extend fiber connectivity through uses of various technologies, wireless technologies, including TV white spaces, which we have worked with Microsoft to develop use cases for. The problem is that because of the dispersed nature of population, so for instance, in Kenya, 70% of the population is rural. Because of the dispersed nature of populations, it's very expensive for typical infrastructure providers to extend that last mile. So what Mawingu does is we make use of innovative business model and technology model, or really innovations to reach these people sustainably. I'm sitting here in Nanyuki, which is a town 3 hours north of Nairobi, with a population of 80,000. And this is one of the largest population centers we serve. We operate across 10 counties today in Kenya, with a population under cover of 9 million. And here we serve people for as little as 10 US cents a month. And for as little as that, they get access to life-changing connectivity. Our customers include individuals, such as a woman in Nanyuki, who, this is a real customer who has a disabled child who was unable to do her secondary schooling from school and used one of our public Wi-Fi hotspots to study from home. And today she's studying medicine from one of the local universities. Our customers include businesses such as a digital center in Narumoru town, not too far from here, which provides access to online resources such as e-government services for 300 people in its community. And our customers also include homes, such as the rural livestock farmer in Isiolo, who lives in a mud house, which he built himself, with no TV, no running water, not even electricity. So he has to use solar for his connectivity. But he was so progressive that not only did he get an internet connection, he proudly proclaimed that he would even let his wife make use of the internet connection. So since we started in 2012, we've been refining our business and technology model, which allows us to sustainably provide connectivity in these areas. And Microsoft has been an incredible support through this journey.
So Brian, you mentioned technology innovations and business model innovations, and I want to get a sense of both. So first, sticking with technology, and then we'll talk business model innovations. How exactly, I mean, not to get too nitty gritty into the details, but for those who are less familiar with the internet access space, how does this work technically speaking? For example, I know TV white space is part of the technology approach. So can you talk about technology innovations and what does that look like in terms of infrastructure and work on the ground? Then we'll get to the models.
Sure. Well, we mainly make use of wireless technologies to extend the last mile. As I said, most people in Africa are accessible for fiber connections with the use of the right wireless technologies. TV white spaces is a big one. So what you need is technologies that enable you to reach people in cost-effective ways, because a lot of these people are in places that are not densely populated. So I'll give you an example. What we do is we find a fiber line, we essentially plant a mast on top of the fiber line, and then we transmit the signal wirelessly. We work with the backhaul fiber providers to get fantastic rates for fiber breakouts as part of the partnerships that we have, because we do it at scale. And then when we plant a mast, a typical mast for a mobile network operator will cost $200,000 to $300,000. One of our masts, which we have innovated on, costs us $10,000 to $15,000. And with that $10,000 to $15,000 mast, we're able to reach people with direct line of sight within 25 kilometers, and we can bounce the signal off several times, 3 to 5 times, so that we can reach people over 100 kilometers away from our fiber line using our technology. The radios that we use are also quite innovative. So I've mentioned TV white spaces, which is essentially the use of unused spectrum that was traditionally used for transmission of terrestrial TV signals that happens to be quite useful for transmission of internet signals with the right technologies. Now, that equipment and those technologies have been quite expensive in the past, and Microsoft has been incredibly helpful in helping to drive the development of use cases. You need lots and lots of people to use the technology so that it can become cheaper and cheaper to produce and cheaper to deploy. And that's what's been happening. So that's just an idea of the kind of technology innovations that we have rolled out in order to reach the places that we do reach.
Great, thanks, Brian. And
yeah,
then,
can I jump in there?
Please.
Yeah, I just want to underscore how important that point is that Brian made in the use of creative and alternative technologies to cover people quickly, because something like TV white spaces, as he explained, is like terrestrial television, the same piece of the spectrum. And so just like your television goes really far, but your little hotspot in your house doesn't go very far, that's because of the way the wave works. And so when you think about the vast areas that need to be covered, if we all rely on fiber, we're never going to get there. And so the investment and the utilization of wireless technologies is fundamentally critical to how we start covering people in the rapid way that we need to. And I think when we started looking at our US program a few years ago, all the learnings that we had from markets like Kenya, we could take those and think, how do we cover the rural US? It was something that maybe we hadn't focused on, and we've taken so many great learnings from what has happened globally and brought them to the US to start working on connectivity. But it just tells you kind of how much you can learn if you're working creatively in different areas and bringing that together and then scaling it to deploy in other areas. It's just been fantastic in terms of what we can think about how we can accomplish things much more quickly than this, this hyper focus on fiber. Fiber is important, there's no doubt, but we can't get over focused on fiber to cover people quickly and economically.
Absolutely. Totally agree on this need for, as you put it, creative and alternative technologies. Now, when it comes to how to finance these technologies, one of the challenges is, the world of financing perhaps not keeping pace with the world of technological innovation in the internet access space. At least that's something that I've seen. one of the points that came up actually in the Future of Development Finance last year was that the banking world, including development finance institutions, already knows how to finance large telcos, for example. But there are these new business models, Mwingu networks among them, that are ready for new types of financing and need new types of financing, and financing is the barrier. So let's connect this conversation to the future of development finance. Where are we right now when it comes to financing these creative and alternative technologies for internet access? Where are we now? What more is needed, and how can development finance institutions play a role? And either of you can jump in on that.
Sure, I'll jump in, and I'm sure Brian has a big perspective on this as well, as being one of the people that really uses a lot of this. But what I'll say is what we've seen, at least in the last year since I was here a year ago, is there are efforts to do some more creative financing. A couple of things that we've done has been, we have a partnership with the USAID, who gave $5 million in funding from the Women's Global Development and Prosperity Initiative to work with partners in rural areas in Colombia, Ghana, Guatemala, India, Kenya, certainly with Mwingu networks. And that has also that focus that I think is so important, which is on women, on bridging the gender digital divide. We've also signed an MOU with DFC to work together on projects. So when you think about, we have the expertise with our partners to do these innovative, creative things. And so the partnerships that we've been able, these public-private partnerships, have really, I think, enabled us to expand the possible in terms of development financing. And I think Brian's probably got loads of ideas on what could be done in the financing area, but we do need to ensure that people are thinking more flexibly and more creatively in this space. So, Brian, sure. I bet you've got a lot to say on this one.
Brian, absolutely, Shelley.
Can I ask you a quick question, Brian? Can you also just expand on Mwingu networks and sort of how your financing has worked, how you've raised money in the past? And then we'll get to this larger question around what more is needed for the space. But I want to hear what this looks like for Mwingu networks in terms of the challenge of financing, and then broaden out to your larger points on the sector as a whole, if that makes sense.
Sure. So Mwingu has been incredibly fortunate, and that is mainly as a result of our affiliation with Microsoft as part of this, and running back from before the Airband initiative for rural broadband connectivity was established, and because Microsoft took a risk on us, it's been easier for us to get financing, venture type financing from angel investors. We recently raised a round of financing from institutional investors, but we also have, we've also received a round of a facility from the International Development Finance Corporation from the US. But the reason all of this has happened, if I'm to be honest, is because of the bet that Microsoft took on us. If we weren't affiliated to Microsoft, we would be, just another Kenyan internet service provider in rural areas. Not many people would have heard of us. It would have been very difficult for us to convince these financiers of the viability of the model. They wouldn't have taken a second look. So yes, we have been fortunate, but the reason we've been fortunate is because of what Microsoft how Microsoft has worked with us. And then to your earlier point around sort of how development financing opportunities for development financing, I think what I'd like to point out is the opportunity presented recently by the COVID crisis. And we've seen two types of reactions from financiers during COVID. And what distinguishes the two is either a failure or the ability to recognize or respond to the understanding that COVID is a perishable opportunity for acceleration of plans for universal connectivity, right? The opportunity will expire. It's not going to be around forever. And the two approaches we've seen are, on the one hand, there are those who have adapted their traditional processes to accommodate the challenges and opportunities of the time, and have made financing available for the sort of projects that we can carry out now to accelerate the actualization of plans for universal connectivity, which then enables us to move fast to meet the challenge now. And on the other side, we've seen a lot of financiers declaring commitment to COVID efforts, but being unable or unwilling to change how they typically work, right? Which means that by the time their financing or the results of their financing comes to bear, it will be too late. So, this COVID has been a fantastic opportunity for financiers to really get with the program. Not everyone has responded the best way, and it has really shown that the problems that a lot of these financing institutions are set up to solve are those that are around for some time, are those that are going to be around for a long time. But we now have an opportunity to accelerate plans for connectivity, as Shelley said earlier, and people really need to take advantage of this opportunity or else lose it completely.
Such a powerful point. Yeah, go ahead, Shelley.
Yeah, and I just want to say, I love how Brian said they would be nowhere without Microsoft. The truth is also that Microsoft would be nowhere in covering people in Kenya if it was not for partners like Mwingu Networks, because they are on the ground every single day working with customers and getting people connected. It's just such an important piece of the equation.
It was really interesting for me to hear sort of what that endorsement has meant for Mwingu Networks. And quick question for you, Shelley. I mean, for organizations that hear about that with Mwingu Networks, and maybe they're in that position of just being another ISP working to connect the unconnected. I mean, what is Microsoft looking for in terms of partners for Airband and other initiatives? Quickly, because we only have a minute left.
Sure. We look to a number of things. We look for people who are connected or on the ground who understand the needs of the community that they're trying to connect. That is the number one thing. So the great way to contact us is through our website, the Airband Initiative, but fundamentally some expertise in technology, certainly, and working on doing this, and a commitment to it, and a commitment to covering people quickly and affordably, and understanding the needs of the community.
And Shelley, I'll ask you one more question to close, which is, a year ago, you announced these plans to connect 40 million people by 2022. Here we are. A year from now, I look forward to hearing what progress you've made. But over the course of the next year, what's one call to action when it comes to what Brian mentioned is this perishable opportunity for accelerating plans for universal connectivity? There's a role for innovative finance to play. So what's your call to action in terms of the role innovative finance can play to make sure that we don't lose this opportunity in the next year?
Yep. I think we all know that we cannot continue to do things like we've always done them and expect a different result. So we need to act flexibly, we need to act quickly, but we also need to act in a way that is inclusive. We have an amazing opportunity right now as people are focused on this to accelerate it. So flexible financial models. I mean, you guys are the experts on that are out in the audience. You know how to do that. We know what the pain is that we suffer. So we've got to get together and figure out what are those things that need to be done. So, I would just say everyone needs to be a little bit more creative and a little bit more flexible, and act with significant urgency and inclusion.
Thank you both so much for your time on this session. Looking forward to following your progress in this work.
Thank you. Looking forward to next year.
Yeah, me too.
Bye.
Thanks, Catherine.
Thanks, Catherine. We're getting close to the very end of our program, and I wanted to thank everyone for being with us today. We've had some really interesting conversations, from the specifics about this crisis to sort of the bigger picture of development finance. We've talked about debt and blended finance. We've talked about impact management. We've talked about inclusion. And so it's my pleasure now to welcome Sony Kapoor, who's the managing director of Redefine. And Sony always brings a fresh and honest perspective to things. And I've always appreciated his sort of frankness and the way he's able to hone in on what's important. And so, Sony, I wanted to invite you to sort of reflect on the event and share with us what have been sort of the three most interesting or surprising things from the event today that have stood out to you.
Well, the one thing is kind of what's been missing, I think, and that's been, it's been mostly a positive picture. And in particular, the innovations we heard about both on the IT side in the last session and on healthcare. I mean, that's been surprising and fantastic, right? And those will have long-term positive consequences. We will end up with far more interconnected worlds. We will end up with a far better public healthcare system with loads of, last mile delivery, vaccine infrastructure, et cetera, which is fantastic. The potential downside is that we will also end up with a data point where, despite all the fantastic stories we've been telling about how wonderful the growth opportunities in emerging markets are, we will end up with a year or 2 years of having 20-25% falls in currencies, large increase in defaults, and clearly exposed limits, as the IMF pointed out, in the ability of those governments to intervene countercyclically. What does this mean for the investment thesis that either the JP Morgan Development Bank or Allianz or other private investors looking to invest in, let's say, Kenya or Zambia have been going to do? So will they be looking at this and saying, well, we need to price that additional risk in? Or will they say this was a one-off pandemic and this is force majeure and this is not going to be repeated, so we just continue with business as usual? So I think that remains the big crucial question. So clearly there has been a large change of mindset. There's been a lot of resilience that has come across, including from the DFIs and remote due diligence, etc. And of course, a lot of innovation. But I think the big macro picture, that question of, what will COVID mean for the macro case, that one makes for emerging markets in general and lower income countries in particular, mean in terms of scaling up development finance with just 10 years to left. So that was one big thing. The second thing that really stood out was, I think Remy's presentation was fantastic. And that was about the intermediation issue, right? So we do have this pool of capital, which now, thanks to quantitative easing, is 11 trillion more than that was the case before. And at the same time, we do have these fantastic opportunities. I mean, the demographic trends remain the same. These new innovations potentially increase future growth rates in Kenya and Zambia. And of course, the fact that we've potentially reduced the cost of connecting the two through better IT and remote due diligence, etc. But if public development banks do operate as a coherent system, being able to connect on the ground presence with the big macro picture, the kind of work that only the World Bank can do or the large bilateral, multilateral development banks can do, working together with the private sector, then some of those intermediation challenges can be solved. And that would be potentially very, very promising. And if at least some of the QE money that is floating around being reinvested in the markets again and again can be diverted to the system of public development banks, in the same way that, for example, ECB funding is available to the European Investment Bank, and a number of countries, the central banks are able to offer credit lines to their development banks. But if one is able to do that globally, that would turn out to be absolutely fantastic. The third thing is, and again, I think Remy pointed this out, there's the quantity of finance, which we've spoken about, but the quality of finance, that was all of the sessions around impact. Now, the crisis, I think, in the long term will be good for us because a lot of those impact issues will have been positively impacted by COVID. It really does matter how finance is allocated. It does really contribute to resilience. It does really matter who is funded and the definition of, the newly fashionable critical worker, not just at the NHS in London, but also the person growing wheat in Kenya, without whom we are not going to have bread in the UK, right? I mean, everybody's a critical worker. So that was all fantastic. The slight downside I see with the, optimism expressed is there are serious limits to attributability. There are serious limits to measurability. There are serious limits to information. And in some ways, by trying to make all of finance align neatly with the SDGs by focusing on reportable, measurable, verifiable metrics, we might actually be damning exactly the places that most need our capital. It is much harder for an investor in Oslo, where I sit, to verify what is going on the ground in a rural Kenyan community. And in most cases, investors are lazy, as most of the rest of us are. I would rather invest a large chunk of money in neighboring Sweden, where there's a clearly articulated case for a publicly listed company, something you pointed out, right? When somebody was speaking about 1,800 large listed companies, the point you made was that actually that is not the places that need our money, right? I mean, at this point in time with QE, no large listed company anywhere in the world is really, really in need of your money or mine, or the money from Remy or the development banks. It is exactly the places that are hardest to track down, to verify, to report on, that most need our money. And so those trade-offs, I think, are going to become very obvious. But on the whole, we are really at the cusp of large changes, both positive and potentially negative. And what happens in the next chapter depends on, I think, everybody tuned in here.
Thank you, Sony. And I love that you closed with what happens next depends on what we all do. That's a really powerful call to action. So I appreciate your take. And you have an amazing ability to synthesize several hours of programming. So thank you so much. I want to thank you all for joining us. Thank you to Adva for all of her work on this session, and to the whole Devex team for pulling this together. Recordings of these sessions will be available on devex.com on demand. We invite you to explore our Future of Finance theme at Devex World online on December 10th. More information on how to register at devex.com/DevexWorld. We'll be continuing the conversation there. Huge thanks to our partners, FinDev Canada, IDB Invest, and Microsoft for helping to make this event possible. And to all of you for your time and participation and the questions you asked. Even if we didn't get to them, I know that they will be informing our future coverage. I know Adva was taking close notes for her upcoming coverage of these issues. Finally, if you can fill out the post-event survey, it should pop up for you in a separate window. We would really appreciate your feedback. With that, we hope you all learned a lot. I know it's not quite the same convening virtually versus in person, but in addition to all that you learned, I hope that you have some ideas for connections you can make or actions you can take. And we look forward to following your progress in this space. Thank you.
Thank you, everyone.